Hello, all of you. I hope you are doing good. So today we are going to revise a very important chapter, that is amalgamation of company. Let me tell you honestly that here now, generally people believe that, sir, it is a very difficult chapter. But to be honest, that it is not at all a difficult chapter. It is easy chapter. But what is important that you have to understand concept properly. That if you know each and every concept, definitely you are going to score 14 out of 14, because in every attempt, IC asks you one single question on this amalgamation of company chapter of 14 marks that here. Again, and you can score that here. It is not at all a difficult chapter. So what we'll do that here now, first we are going to discuss each and every concept that here, and we are going to cover the question that around 10 questions we are going to cover here, which is very important from examination point of view and for the understanding point of view. I read your messages yesterday that here some student asked me that, sir, can you make a single question that here where we are going to cover all the adjustments. Let me tell you that here in the top 50 question that here, this PDF that we have shared with you, this top 50 question that here on other than AS has different series that here. But here in these top 50 question, almost all the adjustment of every chapter covers here. Okay, so you don't have to worry for that. For example, as today we are going to cover amalgamation chapter. So what happened in amalgamation, in 10 question, almost every concept is covered there. Okay. Now, so if you solve these 50 question that here now, it means that here now of all these chapters, total questions here, the 50. Once you cover those 50 questions, almost all the adjustment you have covered there. Okay. And they separate 100 questions for accounting standards there. Okay. So we'll start this chapter that here. I'm very excited that here because I will do my best to make it simple to this topic, and it is easy, very simple topic that here. But understanding is very important that here. Here it is rapid, you can see that here each and everything is properly explained there, and I will tell you that here one by one each of them there are proper steps. You can see that here. Step to solve the practical question of amalgamation. There are 4 steps. I will tell you that here. Okay. Then each and everything we are going to cover here. Journal entries that here. Okay. There's so many things here. Okay. It will take time, but no problem. It is important chapter from examination point of view as well. Okay. So many things. Okay. So let's start that here now. First is I will start with the meaning of this amalgamation that again there's so many things that we're going to cover here. Okay, one by one that here. So even though first of all that here this amalgamation of companies, it is covered by which accounting standard? It is covered by accounting standard 14. So basically this is accounting standard 14 that here, and it's come for 14 marks in examination. Okay, so understand 3 meaning is important that here now. What we mean by that here is amalgamation, absorption, and external reconstruction. These 3 terms. Okay. When 2 company come together and form a new company, we call them amalgamation. They say formation of a new company by merging 2 or more existing companies, we call them amalgamation. For example, if I say that, okay, A Limited and B Limited, okay, they come together and form a new company, let's say the C Limited. So what is important that here now? C Limited, when they form, it's a new company. Okay, understand this one. It's a new company. And these are the old companies. So one company, that is C. Okay, there's a purchasing company. It's a new company. So 2 company, these are the old company, and they will liquidate. And the A Limited and B Limited will liquidate, and they will come in the form of new company will form, and we call them C Limited that here. So the formation of a new company, which is important that here, by merging 2 or more existing company. So it was existing company. Now what is going to happen that now these 2 existing companies come together to form the new company. Okay, and this new company will, and these 2 company will liquidate. Always remember, the vendor company will liquidate that here. It's a purchasing company, it's a vendor company. The purchasing company will take over A and B, and A and B will liquidate there. Okay. Now, same thing they are saying, A Limited and B Limited merge to create a C Limited. A Limited, B Limited are dissolved, and C Limited is what? The formed here. Okay. Then this is second term is absorption. What happened in case of absorption that here? Suppose here there is a company called N Limited, and there is a company called M Limited. Now understand the difference here. One company, existing company, take over the business of one or more existing company, whatever. But what is important here is this is existing company. So one existing company will take over the business of another existing company. This is a difference here. What it might be 1 or it might be 2, whatever that is. But purchasing company always be 1 that is. But they say this is difference. You know what is the difference here? Here In case of amalgamation, purchasing company is a new company. In case of absorption, purchasing company, existing company. So one existing company take over the business of another company, another existing company. What we call them? Absorption. Amalgamation is two existing company come together and they form a new company. New company comes here. Okay, this is a difference here. It's a new company. It's an existing company. Okay, so M Limited acquire N Limited business. N Limited will dissolve. Always the vendor company will dissolve. Okay, this is a purchasing company and this is a vendor company here A and B. This is a purchasing company M and N Limited is a vendor company. Now, what is external reconstruction? Here, new company formed to take over the existing company. What does it mean? If I say that there is a company called, let's say, X Limited, and X Limited will liquidate and the new company will come, for example, new X Limited. Now, certain time happened that here now it's a new company. It's a new company. Basically, certain time happened that now one company take over the business of another company, but this company is a new company. It's a new company. Okay, new X Limited. Certain time it happens the same company, but their name brand is not good in the market, even though they're doing so good, but the people don't like that brand in the past. Maybe some of the bad experience that they have. So what they do, they liquidate the company, they come with a new name in the market. So when they come with a new name in the market that here now, so new company is going to form. So they get confused here in absorption, in external reconstruction. Here in case of absorption, existing company will take over the business of another existing company. Here, new company is going to take over the business of another existing company. You got the point that here now? Here, existing company and new company. In case of amalgamation, at least two company will come together to form a new company. It's an amalgamation. But here, if we see that technically the meaning is different for amalgamation, absorption, external reconstruction that here. And if I see the name of accounting standard 14, that is amalgamation of company, we believe that it is going to talk only for the amalgamation. But the fact is that even though the name of accounting standard 4 is accounting for amalgamation, but that covers all these points: amalgamation, absorption, and external reconstruction area. So it is going to cover all these: amalgamation, absorption, and external what? The reconstruction here. You got the point here? Okay. Now what happened that now one more thing is the internal reconstruction. This is a separate chapter which is not covered by accounting standard 14 that here. So you have to remember these, the meaning of amalgamation, absorption, external reconstruction. What are the common elements which is covered? The common element in these three is it is covered by accounting standard 14. Vendor, also called a transfer company, will go into liquidation. Always the vendor company. Here A and B vendor company, here N is vendor company, here X Limited vendor. All will go into liquidation that here now. Transferring company means the purchasing company acquire the asset and liability of the vendor company. Okay. Now, okay, the transfer, remember that certain people get confused that here. Vendor, okay, vendor here, or you can say that here, transferor. Okay. Now to vendor, we call them is a vendor company. So other we call them the purchasing company. Okay. Now here, purchasing company also called by transferee. Transferee company. Okay. So remember, same thing. Vendor and transfer are both. Okay. Transfer is the company selling their business, and transferee means the company is purchasing the business. Okay. Remember this. Okay. Now difference is not so important. Okay. Still, what the meaning that here? Amalgamation means involve winding of two or more company will wind up, a new company will form. Here one existing company will take over the business of one or two more existing company. Here the new company is formed to take over the business of another existing company in case of external reconstruction. Minimum number of companies involved, at least 3 companies, because 2 companies come together to form a new company. So at least how many companies? 2 existing company and 1 new company. So at least 3 companies. Involve at least how many companies? 2 companies in case of absorption, because one existing company will take over the business of another existing company. In case of external reconstruction, also 2 minimum companies. The reason is that 1 new company is formed to take over the business of another company. Now, number of resultant company. Resultant company means that here now the new company that here. Okay, result in new company. The result in the only one new company will come. Here in case of absorption, no new company comes. Why? Because of one existing company take over the business of another existing company. Therefore, there is no new company here. Okay. Result in only one new company. Yes, because one new company will take over the business of another existing company. Simple. Okay. Just no need to mug up anything. Just remember that here now amalgamation means 2 existing company will come together and form a new company. Absorption, one existing company will take over the business of another existing company. External reconstruction means one new company will take over the business of another existing company that year. Okay. What is the objective here? In case of amalgamation, when there is so much of competition between the company, so much marketing costs happen, okay, and they have to reduce the sales price because of competition. So what they do that here now, aim to reduce the competition that here, they do the amalgamation. Absorption also, same logic. But in case of external reconstruction, focus on reorganization, the financial structure of the company they want to change. Same, but they liquidate the company and they come with a new name in the market. Example here, in case of amalgamation, A and B form and a new company C Limited. Here A Limited take over the business of B Limited. Here B Limited is formed to take over the business of A Limited. Okay. Anyways, but understand the meaning. Amalgamation, two existing company together form a new company. Absorption, one existing company will take over the business of another existing company. And here external reconstruction means one new company will form to take over the business of another existing company. Now this is important. Understand the accounting overview of the chapter that here. Okay. Now how many parties we have? Two parties, at least purchasing company and vendor company, correct? So let me talk to you first about the purchasing company. What happens in case of a purchasing company is that now, first here you can see that here. Now first is a purchasing company and we have a vendor company. So what happened in case of a purchasing company? So when we talk about accounting that here, so we have to do the accounting in the books of purchasing company and accounting in the books of vendor companies. I will discuss about the vendor company later on. First, we will focus on that accounting in the books of what? The purchasing company. Now, accounting depends in the books of purchasing company what kind of amalgamation it is. It means that here now, I am talking the purchasing company, not vendor company. Forget about the vendor company timing that here. Okay, just focus on the purchasing company. So when purchasing company do accounting in their books of account, what happened that when purchasing company do accounting in their books of account, what happened that it depends what kind of purchase it is. Amalgamation in the nature of merger or amalgamation in the nature of purchase. So there are two types of amalgamation, in the nature of merger and in the nature of purchase. The accounting depend in the books of purchasing company whether it's amalgamation nature of merger or amalgamation in the nature of purchase. If it is amalgamation nature of merger, then they have to follow an accounting method. We call them pooling of interest method. I will discuss that. Okay. Now the first question will come in your mind that, sir, you are saying that if it is amalgamation, first of all, we are focusing only for the purchasing company. Forget about the vendor company. Okay. So we all are purchasing company. So when we do the amalgamation, the accounting depends at here now whether it is amalgamation nature of merger or purchase. If it is amalgamation nature of merger, then we have to follow accounting method. We call them pooling of interest method. So if it is amalgamation in the nature of merger that here now, we are going to solve the method, the pooling of, we are going to solve do the accounting by the pooling of interest method. We say, okay, I will discuss with you what is pooling of interest method here. But how to come to know that here now, that it's an amalgamation in the nature of merger. How will come to know that here, that it is amalgamation in the nature of merger that here. So there are 5 conditions. There are 5 conditions. If all those 5 conditions are satisfied, then we call them amalgamation in the nature of what? The merger that here. So what is going to happen now here? If it is amalgamation in the nature of merger, okay, when we call them amalgamation in the nature of merger, there are certain 5 conditions. I will discuss with you those 5 conditions that here. Okay, if those 5 conditions are satisfied, so we call them amalgamation in the nature of merger, and we have to do the accounting in the books of purchasing company by pooling of interest method. Okay, understand the structure first that here. Okay, so we are in the books of purchasing company. If it is amalgamation nature of merger, then we'll do the accounting by pooling of interest method. When we call them amalgamation nature of merger, if there are certain 5, I will discuss those 5 conditions. If those 5 conditions are satisfied, then we call them amalgamation nature of merger, and then we have to do the accounting by pooling of interest method. But if any of those 5 conditions not satisfied, I am saying if any of those 5 conditions not satisfied, then we call them amalgamation in the nature of purchase, and then we have to do the accounting by purchase method. Now let's create a structure first here. We are in the books of purchasing company. If 5 conditions are satisfied, it is amalgamation nature of merger, and we have to do the accounting by pooling of interest method. If any of those 5 conditions not satisfied, we call them amalgamation nature of purchase, and we have to do the accounting by purchase method that here. Okay, this is structure that is. But what happened that now? We are in the books of purchasing company. What are those 5 conditions? Because I am saying that there are 5 conditions. If those 5 conditions are satisfied, then we call them here the amalgamation nature of merger, and we have to do the accounting by pooling of interest method. If any of those conditions not satisfy, so we call them amalgamation in the nature of purchase, and we have to do the accounting by purchase method that here. Now the question is, what are those 5 conditions that here? Okay, so you can see that here. Before I come to time, okay, here types of amalgamation as per is 14 that here. So point number A, I'm discussing 5 conditions. It will be called the amalgamation nature of merger that here if only if all the following 5 conditions are satisfied. If these 5 conditions are satisfied, we are going to call them amalgamation in the nature of merger. And in the case of amalgamation nature of merger, we are going to do the accounting by pooling of interest method here. So what are those 5 conditions? What are those 5 conditions are there? Okay, what are those 5 conditions are there? First, all asset and liability, including the reserve of the transferor, means the vendor company, are transferred to the transferee. It means all the assets and liabilities that here, it will be including the reserve that all asset liability including the reserve that here is going to be transferred from vendor company to the purchasing company. Okay, then it says here all asset and liability including the reserve are transferred at the book value. So first of all assets and liability including reserve will transfer to the purchasing company, the vendor company, purchasing company. All asset and liability including reserve are transferred at what price? Book value. No change in book value. If the land and building appearing is 10 crore, it is going to be transferred at 10 crore only, no change in book value. So I am saying that now it's a vendor company and it's a purchasing company. Vendor company transferring asset and liability, all asset and liability should be transferred that year. Okay. The second, all asset and liability should be transferred at what? Book value. But there is except for ensuring consistent accounting policy. What does it mean? That is one exception that in general, we have to transfer all the asset and liability by the vendor company to the purchasing company at book value. But one exception where we can change that. What is the exception that here? They say here now is for ensuring the consistent accounting policy. Let me give an example. What does it mean that here now? If I say that here now, A limited is vendor company and B limited is purchasing company. So what happened here? They have to transfer all asset and liabilities. Correct? All asset and liability should be transferred by vendor to purchasing company. And it should be transferred at book value. This is a general rule is that. But exception is that for the purpose of consistent accounting policy, they can change the value. What does it mean for the purpose of consistent accounting policy? It means that, for the purpose of consistent accounting policy, it means that is what is going to happen now here? They say that here, if the policy is different, let me give an example there. Suppose here A is following the FIFO method for the purpose of valuation of inventory, and B is following weighted average method for the purpose of valuation of inventory. So when A is going to transfer here, all the assets and liability to B, so inventory will also transfer. Correct. Inventory will also transfer. But the inventory of A will merge to the inventory of B. But B is doing the valuation by weighted average method. A is doing the valuation by FIFO method. So when they merge, the valuation has been done for some stock on FIFO, on some stock weighted average method. So here they have to make it a consistent. How can we say that some stock on FIFO, some stock on weighted average? They have to make it consistent. So in that case, we can change the value of the inventory to make it consistent. You got the point here? In these cases only it is allowed to change the book value. So first, all asset and liability will transfer to the purchasing company. All asset and liability should be transferred at what? Book value, except in case of ensuring the consistent accounting policy, we can change the value. Then they say here, at least 90% of equity shareholder become the equity shareholder of the purchasing company. So at least 90% equity shareholder of the vendor company will become the equity shareholder of the purchasing company. Then they say that, okay, then consideration for vendor company equity shareholder are discharged wholly by issue of equity shares in purchasing company, except that cash may be paid for fractional shares. What does it mean that? First of all, in point number 3, they say, first they say all assets and liability transfer. All assets and liability, second, should be transferred to book value. At least 90% shareholder become the equity shareholder of the purchasing company. And to the equity shareholder, obviously when you acquire a business that year, in return we have to give it something to them. Suppose I am acquiring your company. So when acquiring your company, I will take your asset and liability, but I have to give you something in return. Na? So when I will give you something in return, I have to give to you only the equity shares. So I am acquiring your company. For that, I am giving to the shareholder of your company, I am giving you the shares of my company. You got the point that here now? But they say that here, but for the fractional share, I may give you cash. For example, suppose one share of my company is, let's say that 10. And your one share is, let's say that here is, I'm going to say the 11 that year. Okay, so I cannot give you my one share of 1.1. I cannot give you fraction. So one share I will give you of 10, one fractional amount I can give in the form of cash. That is a law. But in general rule is that when I take your company that here now, into your equity shareholder, I will give the equity shares of my company. And the last point is that here, business of the transfer means vendor company should be carried on by the transferee, means the business of the vendor company will carry on by the purchasing company after what? Amalgamation. Now understand this. If all these 5 conditions are satisfied, we call them amalgamation in the nature of what? Merger. So what are those 5 conditions that here? The first, all asset and liability of the vendor company will become the asset and liability of the purchasing company. All asset and liability of the vendor company will be transferred at the book value. Exception is that for the purpose of consistent accounting policy, value might be changed. At least 90% shareholder of the vendor company will become the shareholder of the purchasing company. Or to the equity shareholder of the vendor company will give them equity share of the purchasing company only for the fractional share they can give in cash, and the business of the vendor company will be carried on by the purchasing company after amalgamation. If all these 5 conditions are satisfied, we call them amalgamation in the nature of merger. Now very interesting point. If suppose that any out of these 5 any condition not fulfilled, does that mean that out of these 5 conditions that here, if any of these conditions not satisfied, does that mean that there is some violation of law? No, not at all. They are saying that these are the 5 conditions to call it amalgamation nature of merger. If any of these conditions not satisfied, I will not call it amalgamation nature of merger. In that case, if any of these 5 conditions not satisfied, I am going to call them amalgamation in the nature of purchase. So, there is no violation of law that here. These are the 5 conditions. Fulfill, okay, call them amalgamation in the nature of merger. If any of these conditions not satisfied, call them amalgamation in the nature of purchase. If it is amalgamation in the nature of merger, look at here. We are in the books of the purchasing company. If it is amalgamation nature of merger, when those 5 conditions are satisfied, we are going to solve by pooling of interest method. If any of these conditions not satisfied, we call them amalgamation nature of purchase, and we are to solve by the purchase method that here. So method is going to be different that here, but there is no violation of law. We'll still do the accounting that here. Now they say here, amalgamation nature of purchase that here. If any of the above condition not satisfied, then we call them amalgamation in the nature of what? Purchase that here. So in case of amalgamation nature of purchase, we are going to do the accounting by purchase method. If all of those conditions satisfy, we are going to solve amalgamation nature of merger, then we solve a pooling of interest method. This is how we do the accounting. Now what is pooling of interest method? What is purchase method? I will discuss with you later on. But what about the accounting in the books of vendor company? This is what we're discussing in the books of purchasing company. Now what happened that if accounting in the books of vendor company, when I see that here, they say accounting standard 14 is silent. What does it mean that here? They say no, S14 is silent here. S14 is silent here. S14 says that no, I don't want to teach you how to do accounting in the books of vendor company. I ask you what happened that here. When it's come to the purchasing company, you are telling us that here, you are guiding us how to do the accounting in the case of amalgamation nature of merger, amalgamation nature of purchase, to method, you are guiding us how to do the accounting in the books of the purchasing company. But when it's come to vendor company that here, I'm asking you that here, when it's come to the vendor company, tell me the accounting. They say, no, I'm silent here. S14 is silent that here when they talk about the accounting in the books of vendor company. The reason is that, what is the reason is not mentioned there, why they are not saying anything about the accounting in the books of vendor company. The reason is that here, because here, there is no rocket science here, because vendor company is going to liquidate. Anyhow, vendor company is going to liquidate, they just have to close their books of account. So it means that here there is nothing special when we talk about the vendor company that here, because that company is going to liquidate, they just have to close their books of account. So nothing is special to tell how to close the books of account. This is what S14, that's why they are not saying. That does not mean we are not going to close the books of account of vendor company. I will teach you that here. How to close the books of account of a vendor company, even obviously S14 don't find anything special in that. So they are not guiding us how to close the books of account. But we have to do that. And there is nothing special in that I will teach you that how to close the books of account of vendor company. So basically, here my charter amalgamation of company, when I talk from the accounting point of view, it is categorized into three parts. What is the first part? First part is that here now, first, second and third. First is that in the books of the purchasing company that here now, the amalgamation nature of merger. In the books of purchasing company, amalgamation in nature of purchase, and how to close the books of account of vendor company. These three parts. The complete amalgamation chapter is divided into these three parts that here. Okay. So what I will do that, I will discuss each of them one by one. I will discuss with you. It is super easy and you are super talented. Don't worry about that. You are going to score 60 plus in account. Nobody will be stop you that here. 100% you are going to score 60 plus in account, but be confident that here. You are so special. I always tell to my student, you have so much of caliber. You have so much of caliber. Just be confident that and see the miracle what happened. See the complete series of this amalgamation, this marathon, and at the end of the chapter, you will say, oh, it is so easy. Nothing is special in that. It is very easy. Okay, now listen here. So what we'll do that here, we'll categorize the chapter into this amalgamation to 3 parts. Okay, in the books of purchasing company, in the nature of merger, in the nature of purchase, and in the books of vendor company, even though S14 is silent, but instead ask, I will tell you how to do the accounting of that. But what happens is before I come to these 3 parts that is one by one, then we have to solve a question on in that. What is more important for us that is the one concept that I want to teach you that here, and I want to revise that here. What is that concept is we call them purchase consideration, because the purchase consideration is the most important part of the chapter. I will come to all these 3 parts: purchasing company, vendor company. But what is more important for me here, that how to calculate the amount of purchase consideration. What does it mean that here? Let me tell you that here. For example, if I say you that here now, there is a company, say A Limited. Now A company is a vendor company. So they will give their what? Assets and liabilities that here. Okay, obviously that here. Or let's say that here. Let me change that here. A company is a purchasing company. So if I say A company is a purchasing company, they will take asset and liability of vendor company. Okay, suppose you are B, I am A. I am acquiring your company. So I will take your all assets and I will take your all your liabilities. Suppose that all assets and liability I am taking with of vendor company. But obviously in return I have to give you something. Obviously when I take your company in return I have to give you something. To these return we call them PC. We say what is PC? Purchase consideration. That this is the most important part of this amalgamation chapter, because without PC you cannot start a question. The first step will always be to calculate the amount of PC. The reason is that when we do the accounting that year, we should know that what is the value of the business that we are taking that year. So this is in every question, in each and every question of these chapters, you will find it out that here. First, we have to calculate the amount of purchase consideration that year. So before I come how to do the accounting in the books of purchasing company or vendor company, you should know how to calculate the amount of PC. So what I will do that here with you, I'm going to calculate, I will discuss with you how to find it out the amount of PC that here now. And then what we'll do that is, then we'll come to the part of accounting that here. Okay. So next page here in rapid gist, that is page number here 33. So first of all, you should know the approach that student get very tuned, sir, how to do the account. Very easy, very easy. Don't worry for that. Your amalgamation chapter, these are the 4 steps. Every question, these are the 4 steps. What is step number 1 that here now? They say, okay, what is that here? Steps to solve the practical question of amalgamation. First step that here. Decide the nature of amalgamation. Whether it's specifically given in question that here, that it is the amalgamation nature of merger or purchase, or otherwise assume an amalgamation nature of purchase. Okay, if it is not, I'm going to say that here now. If specifically given in the question that amalgamation nature of merger, then tell them. Otherwise, always be assume amalgamation nature of purchase. Any of those 5 conditions not satisfied. Because generally we don't acquire the book value, we change the values there. Okay, anyways, so most probably at inter-level they will tell you that here. If it is amalgamation nature of merger, they will tell you. Now the second, once you decided, okay, it is amalgamation nature of merger or purchase, because accounting depends on that. Now, if it is the amalgamation nature of merger, you have to solve by pooling of interest method. If it is the amalgamation nature of purchase, you have to solve by purchase method. So it is important to note that what kind of accounting we have to do that here. That we have to know initially that here. Okay. Then they say now here step number 2 is that first we have to calculate what? PC. It is very important that how to calculate PC I will tell you. Then step 3, accounting in the books of purchasing company if they ask you that here, or accounting in the books of selling company or vendor company only if required that here. Okay, if they ask you that, whatever they ask you to do the accounting in the books of purchasing company or vendor company, accordingly we have to do that. But first we have to find out the amount of PC. Now how to calculate the amount of PC, then only I will come to the accounting part. What is PC? You understand that here now? Here A is a purchasing company. They acquire asset and liability. In return, they will give what? Some amount, whatever they give. I will tell you how to find it out. So we call them the PC, that purchase consideration that here. Now the main part come that here now. How to calculate the amount of what? Purchase consideration. Okay, now understand this point here. Let me tell you that. What do you mean by purchase consideration that here now? Okay. Now, please listen carefully. Then I will come to this technical definition that here. There's a company that here now. It's a purchasing company. A Limited. A Limited. Okay, A Limited that here now. will give to the shareholders of B Limited. Let me write here, shareholders of B Limited. Okay, is it visible? Yes. Now I say that here, A is the purchasing company, and in return they will give to the shareholders of the vendor company. Okay, A is the purchasing company. In return, I will give something. What I will give, I will discuss with you, to the shareholders of B Limited. Now, what do we mean by shareholder? It might be equity shareholder, it might be a preference shareholder. So, or both. So, shareholders mean that here now, equity shares or preference shares. Okay, equity shares or preference shares. Okay. So, we all are purchasing company. Okay. Now, assuming you are also purchasing company. Now, what happened here? We all are purchasing company and we are giving to the shareholder of vendor company because we acquired their company. So, when we acquire the company, we are giving something to them. Okay, so take the asset and liability of the vendor company, and in return they are giving something to the vendor shareholders of vendor company. What I can give to the shareholder of vendor company? Remember that I am giving here 4 arrows. Okay, 4 arrows that here. So what happened that here now? A is a purchasing company. We can give to the, first of all, they have to give to the shareholder of vendor company. Equity or preference. What they can give? They can give their shares. I can give. Suppose you are a vendor company and you are the shareholder of vendor company. I can give you shares of my company. Take shares of my company. I can give you debentures of my company. Okay, debentures of my company. I can give you cash, or I can give you any other asset. It means that here now, very important, student get confused here at night. First of all, the amount of PC, when we calculate the amount of PC here, when I want to find it the amount of PC, what is important that here, I am giving only to the shareholders of vendor company. So suppose there are equity shareholders stand here, preference shareholder here, and the debenture holder also. So if anything I am giving to debenture holder, that is not a part of PC that here. I can give only, this is a key point here. When we find the amount of PC that here, I can find it, when I find the amount of PC, I will consider it as a part of PC only when I am giving to the shareholders of vendor company. Remember, I am not saying that we are not going to do the settlement of debenture holder of the vendor company. That I will do it separately when I acquire their company. That is a separate thing. But when I say about the amount of PC for me, PC is not going to cover if I am giving to anyone other than the shareholder. So I'm saying that when I'm giving to the shareholder of vendor company, only that is a part of PC. You know that where the student get confused here? The student say that here. Now imagine you are the shareholder of vendor company. Okay, you are the shareholder of the vendor company. So, okay. So let me tell you that you are the shareholder of vendor company. Okay, vendor company, B Limited, you are the shareholder, equity, preference, whatever. I say take shares of my company. Come on, take it, no problem. This I am giving the shares of my company. Is it amount of PC? Yes. Now I am saying that now. Take a debenture of my company. Student get confused. They say, no, sir. You are giving debenture. Yeah, I am giving debenture to the shareholders. But so anything I am giving to the shareholder, that is a part of purchase consideration. So what I am giving to here, you are the shareholders here. I can give you the shares of my company. I can give you the debentures of my company. I can give you the cash. I can give you that here, or I can give you any other asset that here. But I am giving all these to the shareholders only there. I cannot give to anyone other than shareholder. That is a separate part that I will do the settlement once I acquire your company. But when I talk about the purchase consideration, what is going to cover in the purchase consideration that here? This is what I am giving to you. So you are a shareholder of a vendor company. What I am giving to you, I am giving you the shares of my company. I am giving you the debenture of my company. I am giving you the cash here. I am giving you any other asset. So I can give you anything. But to whom I can give only to the shareholders. So to make you confuse that here, they will ask you to calculate the amount of PC, and they will tell you that here that purchasing company is giving to the shareholder as well as to the debenture. Give it to the debenture, but that's a different settlement. How to do the accounting, I will discuss with you later. But that is not a part of PC if I am giving to debenture holder. Only to shareholder, I am giving to shareholder anything I am giving to shareholder. I have to give to the shareholder, then only I call it what? Amount, then only it will be considered as a purchase consideration. So to the shareholder, I can give anything, share, debenture, cash, any other asset. But to whom I am giving to the shareholders only. This is a key that here. Okay, so understand. So I can give all these. But to whom? To the shareholder here only. Okay, so what it says that now, the total value paid by the purchasing company to the shareholders, of the vendor company. I can give you shares. Securities means here the debentures here, cash or any other asset during an amalgamation. So I can give you shares. Security here means the debenture. Okay, security, you can say that here, debentures. Okay, bonds, anything. I can give you cash or any other asset given to the vendor company. What is not covered, that is payment to debenture holder, creditor or any other liability are not considered as a part of the PC, that is. And we do the accounting them separately. Just like, keep one thing in your mind, that you are giving to shareholder. That's it. To share. Give whatever you want to give, but give it to the shareholder. Okay. Now, it will help us to find it. First of all, we find it out the amount of PC that here. Now I can give it a shareholder. So how to, I mean to say that first is the here, how to discharge the PC. How to discharge the PC means I know that I'm liable to pay you 10 crores, but how to pay that? I can give you shares, debenture, cash, whatever that is. So they will tell you that your consideration amalgamation can be presented in 4 ways. So in 4 ways, any of these 4 they may ask you. Generally, first they don't ask. They will give the lump sum amount, the fixed amount, give it to the shareholder or the vendor company. Okay, like that. Second, they give you the payment basis. What is this payment basis? So they will tell you that the details on how many shares I am giving you, debentures, cash or anything that I am giving you, they will give in question. Like that here. Purchase consideration means number of shares I am giving you, multiply by, they will give you the issue price that here. Plus number of debenture, multiply by at what price. How much cash or any other asset I am giving to you. So they will give us in the question that here, that purchasing is company is giving, for example, 10,000 share at the rate of rupees 15 or 15,000 debenture at the rate of 20 or this much of cash. This is the payment basis. So I know that yet how I'm discharging the PC. Discharging amount of PC is a different thing. Discharging is different. What you are giving to the vendor company. Okay. But shareholders of vendor company. And third, if nothing is mentioned that here now, to lump sum is not given or payment basis detail is not given. So we have to calculate the amount of PC by net asset basis. You will say, what is net asset basis? Sir? Net asset basis means asset minus liability. Listen, when neither a lump sum or nor the payment details are given, we have to calculate the adding the all asset including the goodwill and subtracting liabilities at agreed value. Avoid fictitious asset and undistributed profit means asset minus liability. Okay. So here how to find out a PC? Asset minus liability, and that is what this will be the PC. Net asset will be the here. This will be the PC. Net asset will be what? The PC here. So asset minus liability, what we call them, that is nothing but the PC here. Asset minus liability, that is nothing but a PC here. Okay. Now what happened that here? Net asset. This net not applicable. This is net asset. Okay. Now what happened that here now? If they give you that, I mean, say how many shares, how many debentures we are giving, then you have to calculate by payment basis. Otherwise, net asset basis. But when I say asset does not cover fictitious assets. For example, discount on issue of debenture, okay, miscellaneous expense not written off. Those are fictitious assets. We don't cover it. And when we deduct the liability, the actual outside liability, not reserve and surplus that. Okay. Now, this one more is that here now is the intrinsic value or the share exchange, the method that here. So rarely it happens that here. Most common is BNC. BNC is the common. Okay. The intrinsic value means that calculate the purchase consideration on a net asset basis. Divide the PC amount by the intrinsic value of the shares of the purchasing company to determine the number of shares to be issued. Let me tell you what is this here. Now what happened that now? They will not tell me that here now. At what price? Even when I calculate here by net asset basis. So I will, when I take your business, I will take all your assets. I will take it all your liability. I will take the net effect that here. Okay. And that will be the amount of PC. But here in point number C, they will tell me that here how at what price I'm giving you shares. So whatever net asset come, so that I have to give the shares of that much value to you. Okay, so they will tell me that here now that issue the shares of 10. But how to calculate the amount? So total amount here I will calculate asset minus liability. Net asset come and some of the share is of rupees 10. I will divide it by 10. Number of shares will come that here. But what happened that here in case of intrinsic value of the share exchange method, they didn't tell us that at what price I have to give you the share. For example, that here. A limited is a purchasing company. Now understand it here. And B limited is a vendor company. Please understand. Okay. It's a purchasing company and it's a vendor company. So what happened that here now? I will write it on all your assets. Let's say the 100 crores. I will write it on the liabilities. Let's say they're 40 crores. So your net asset is how much here? Is 60 crore. Okay. Now, then this is suppose my net asset is of 200 crore. A liability is of let's say the 50 crore. So my net asset is 150 crore. But you're a vendor company. I'm acquiring your company. So I will give you this much. I have to give you the share of how much? 60 crore. But at what price? What is the value per share? So they may ask you to calculate intrinsic value. The intrinsic value means here number of shares of my company. Let's say that here number of shares I have here. To make it simple, let's say 50 crore. So intrinsic value basically net asset divided by number of shares that here. So my intrinsic value will come 150 divided by 50. That will come 3. So how much is the intrinsic value of my company? 3. So how much I am liable to give you here? I am liable to give you 60 crores. Okay. But what is the intrinsic value per share of my company? Suppose 3. So this much amount I am liable to give you. And this is the amount of value per share. So 60 divided by 3. So that will give the number of shares. 20 crore shares I am giving you of rupees 3 each that year. You got the point? This is intrinsic value. So we have to calculate the intrinsic value of the purchasing company because they have not given us that here. At what price I am giving you? What is the value of per share? Now read this. Calculate the PC on a net asset basis. Divide the PC. PC means purchase consideration amount by the intrinsic value of shares of the purchasing company. Okay. So what is going to happen now to determine the number of shares to be issued that year? So here the divide the PC. This is the PC amount I am liable to pay. Divided by the intrinsic value of the purchasing company. This is the intrinsic value of the purchasing company. So your PC, amount of PC I am liable to pay divided by intrinsic value of the purchasing company. So to determine the number of shares to be issued. So I will say 60 crore is the net asset of your company. And what is the intrinsic value of per share of my company is 3. So 60 divided by 3, that is coming 20 crore. So I am giving you 20 crore shares of rupees 3 each. You got a point? Okay. So rarely they ask that here. But if nothing is mentioned that here, I'm going to say that if payment basis they will ask you. If they're not asked you, calculate by the net asset basis. But if they net asset basis also, I'm able to find the amount here. But how many number of shares I have to give to you? So they will tell you shares of rupees 10 like that here. If nothing, if they say no intrinsic, they have given the share of intrinsic value. So I will calculate your net asset. But how many number of shares I am giving, I have to find out the intrinsic value. Okay, then only we can find it out how many number of shares I am giving to you. So this is about the purchase consideration. So what we'll do that here now, before I come to the accounting in the books of purchasing company and the vendor company that we have not yet come. Okay. I want to do certain question on the PC. Okay. But remember that here, when we want to find out about the PC, always remember that whatever we are giving to the shareholders of vendor company, I'm repeating, whatever we are giving to the shareholders of vendor company, we call them PC. Whatever I'm giving, I can give him share, debenture, cash, any other asset, but to the shareholders of the vendor company. Okay. So when I find it out here, the amount of PC that I'm giving to the shareholders of vendor company, they might be by the payment basis, they might be on the net asset basis. That this is the most common, B and C that here. Okay. If they tell you on the intrinsic value, then you have to calculate the net asset PC of the vendor company and intrinsic value of the purchasing company, and PC of the vendor company divided by the intrinsic value of the purchasing company to find the number of shares that I'm giving to you. Okay. So before we come to the accounting part that here, what we'll do that here from the Super 50 question that here in your notes is this chapter number 5 that here. Okay, chapter number 5. So many students were sending messages to cover first amalgamation and consolidation. That's why I will come to the buyback and all chapters. I will cover that here. But first, please. Okay. Now come to in page number that here now is 55. So now question number is 25. Now we'll solve certain question on the calculation of amount of PC here. Now come to question page number 55, question number 25. What it says, question number 25. Star Limited agreed to take over the Moon Limited on 1st of April 22. The terms and condition of takeover were as follows. Star Limited agreed to take over the Moon Limited. Who is the purchasing company? Star. To take over Moon is a vendor company. Okay. Now just I'm asking you that here. Is it an amalgamation or absorption? Absorption. Because one company is taking over another company. Okay. Not the two company coming together to form a new company. Okay. Anyways, but PC we have to calculate anyhow. The purchasing company is going to pay to the vendor company. They say on 3 points that here. First, what they ask you that here now is to give the meaning of the consideration. Okay. And then the calculate the amount of PC. So whatever we are paying to the shareholder, that is the amount of what? The PC. That is the amount of PC. Okay, remember whatever we are giving to shareholder. So this is Star Limited issues 70,000 equity shares of rupees 100 each at a premium of rupees 10 per share. Okay, to the equity shareholder of Moon Limited. So to whom we are giving equity shareholder? So I will say that here now 70,000 shares. The price is rupees 100. Plus 10 is the premium amount. So plus 10 I'm not passing accounting entry, which I have not yet covered. I'm calculating the amount of PC. 70,000 multiplied by 110. Yes, that is coming here. How much here? 7 lakh. Sorry, 77 lakh. Okay. Then they ask us that here now. The cash payment of rupees 1,25,000 to the equity shareholder. Again, we are giving to shareholder. That is the amount of PC. So here we are giving cash of rupees how much? 1,25,000. Then they say that here 25,000 fully paid preference share of rupees 70 each issued at par to discharge the preference shareholder. Any shareholder, equity or preference. We are giving to the preference shareholder. So we are giving them here 25,000 shares at the rate of rupees 70. So how much it will come? 25,000 multiplied by 70. That is coming 17,50,000. So when you will do the total here, so how much is coming here? 77 lakh plus 1,25,000 plus 17,50,000. So that is coming here 95 lakh. Okay, 95 lakh 75,000. So simple. Whatever we are giving to the shareholder of vendor company, that is the amount of PC. So you can see that here now, the amount of PC is coming how much here? 95 lakh 75,000. They also asked to define the PC. So basically consideration that here now, for the amalgamation means the aggregate of the shares and any other security issued and the payment made in the form of cash or any other asset by the purchasing company to the shareholder of vendor company. Okay. Now here, second, again 26, question number 26 on the amount of PC. Okay. So what they ask us that here now, calculate the amount of PC and pass the journal entry. I will come to journal entry later on because we have not yet discussed the journal entry. Okay. But the amount of PC we can do that. So first they say that here now, here on 1st of April 2018, Tina Limited take over the business of Reena Limited and discharge the PC as follow. Okay. So who is the purchasing company? Tina take over the Reena. Tina is purchasing company and Reena is vendor company. Okay. Issue 50,000 fully paid equity share of rupees 10 each at a premium of rupees 5 per share to the, again, to the shareholder, equity shareholder. So how will calculate? 50,000 multiply by how much here? 10 is the face value. We are giving it 5 rupees premium. So it will come 50,000 multiply by 15. That is coming how much? 7,50,000. 7,50,000. Okay. Then here cash payment of rupees 50,000 was made to the shareholder of Reena Limited. So we are giving to the shareholder. How much we are giving? 50,000 cash payment. So if anything we are giving to share, equity preference doesn't matter. Now issue 2,000 fully paid 12% preference shares of rupees 100 each at par to discharge the preference. Again we are giving to shareholder, preference shareholder here. So 2,000 shares and price is rupees 100 at par. So it will come that here 2,000 multiplied by 100. Okay, that will come here how much? 2 lakh. 2 lakh. Now fourth pointer. Debenture of Reena Limited. Debenture of Reena Limited means vendor company. Debenture holder of vendor company will be converted into equal number and amount of 10% debenture of Tina Limited. It means the debenture of the vendor company will be converted into debenture of Tina. I am not talking about accounting entry for this. I am talking about the amount of PC. Is it a part of the amount of PC? The answer is no. Because here I am giving something to the debenture holder. So that to call it amount of PC, we have to give it to the shareholder only. Whatever we can give anything to the shareholder. In point number 4, we are giving to debenture holder. That is not a part of the PC. So it will come 7,50,000 plus 50,000 plus 2 lakh. How much it is that here? 10 lakh. So you can see that here amount of PC 10 lakh. Okay. Now they also ask us that a journal entry relating to discharge of PC. Don't worry about this journal entry because I have not yet covered the amount of I have not yet covered the accounting entry. So I will explain you that here the accounting entry. Then at that time I will cover how to pass this accounting entry here. Okay, I will discuss with you this entry. Don't worry for that. We will discuss this accounting entry. Okay, don't worry. Discharge of PC, but you know how to calculate the amount of PC that year. Okay, so in both the cases, which method they have tell us to find it as the amount. Here by the payment basis, they tell us that how many number of shares we have to give, how much cash. Okay. Second is also by the payment basis, we have finding the amount of PC, because they have tell us that here now how much is the number of shares at what price, okay, to the shareholder. Everything is given. How many number of shares we are giving. You can see that here now. These basic details on share, debenture, cash, etc. we are giving. And now don't get confused with debenture. No, debenture I am giving to the shareholder only. So anything we are giving to the shareholder, that is PC. Keep one thing in mind. Anything we are giving to shareholder, PC. Okay. Now, if you remember that when we started chapter that year, I told you that here accounting basically divided into three parts. First, purchasing company, two methods here. Amalgamation, nature of merger, if these five conditions satisfy, pooling of interest method. Any of these conditions not satisfy, amalgamation, nature of what? Purchase. So we have to solve by purchase method. So what I will do that with you now that here, these I am discussing first. Okay, so I am covering these points first that here. Okay, these point I am covering these point. Okay, then I will come to these like that. Okay, so one by one. So you can see that here in point number 6 that here, they tell us that now accounting for amalgamation, the nature of purchase means purchase company applies when any condition for the amalgamation nature of merger are okay. Do the one correction that applies when any condition of amalgamation nature of not met. Do the correction there. Okay, if any of the condition of amalgamation not met, not means that condition not fulfilled there. Okay, any of those five conditions not met. That okay, do the correction there. If any of those five conditions here not met, okay, do the correction there. Okay, now what happened that here now is any of those five conditions that here. Okay, you know that those five conditions that here. Okay, any these five conditions, all asset and liability transfer, all asset and liability transfer a book value. Okay, exception accounting the policy, we can change the value. 90% of equity shareholder will become the equity shareholder of purchasing company. To the equity shareholder of vendor company, we have to give the equity shares only. Fractional shares we can give in cash, and business of the vendor company will continue by the purchasing company. If any of these five conditions not satisfied, it is not a violation of law. It is not a violation of law. It is like that. It is not just amalgamation nature of merger. It is amalgamation nature of purchase only. You got a point here now. So what is going to happen now here? Applies when any condition for amalgamation nature of merger are not met. And what I'm saying that are not met. If any of those five conditions not met, then we have to solve by the amalgamation nature of purchase. So purchase method, they say, do the correction there in the page number 33 with a here you can see not, okay, not met. Then they say purchase method here. They say use for amalgamation nature of purchase. Key points. When we use that here, now I will come to these key points here. First, the general entries they have mentioned. The asset and liability of vendor company record in the books of the purchasing company agreed value. Okay, I will come to that here. All these points. Don't worry for all these points here. Okay, I will come to these points. Key points. First general entries that here now. Now what happened here now? These when I talk about entries that we are, remember that we are passing journal entries in the books of purchasing company. Okay, purchasing company, and which method? Purchase method. Okay, when we have to follow the purchase method, if any of those five conditions not satisfied, then we have to solve it by this method. Okay, now one by one I will discuss with the accounting entry in the books of purchasing company. Now understand this one by one. So what happened that here? We are first of all we're passing entry in the books of purchasing company. So suppose this is a purchasing company and this is vendor company. So purchasing company will take over all assets and liabilities, and it will give certain thing in return. We call them purchase consideration. Now remember that here now. In case of an amalgamation in the nature of purchase, if any of those conditions not satisfied, then we call them amalgamation in the nature of purchase. Okay. Now what we have to solve a purchase method. Okay, so I will take not necessary that I am to take all assets and liabilities. The reason is that whatever is mentioned in the question, that purchasing company is taking that much of asset and that much of a liability and that value, that only we will consider. The reason is that here, because we are talking about amalgamation in the nature of purchase. So you know that in the nature of merger, the condition all asset and liability should be taken over. All asset and liability. But that is not the case in case of if I'm not taking all asset. So nothing wrong in that. I'm not going to call it amalgamation nature of purchase, in the nature of merger. I will call it amalgamation in the nature of purchase. This is what we're discussing. So any of these conditions not satisfied, then amalgamation nature of purchase. So I will take asset and liability, whatever mentioned in question and whatever the price is mentioned. We call it agreed value. Okay. Here the condition is not book value. Okay. In case of a merger, we have to take asset and liability book value. Here any whatever value is given in question. In return, I will give it something to them and we call them purchase consideration. Now we are talking about accounting entry in the books of purchasing company. Now, okay, now we all are purchasing company. Okay. Now what is the first entry here? Now focus here. What is the first entry here now? I am taking the business. We all are purchasing. You and me, we all are purchasing company because always think from entity's point of view. Now we are taking the business that here. Business is going to come. Not yet come. It will come. Business is going to come. Increase in asset. So business purchase account debit. So first entry we pass of the purchase consideration due. First entry is of purchase consideration due. So when I take here the when we are going to receive the business, so business is going to come, which is asset. Business purchase account will be debited. But for that, I'm liable to pay something. For that, I'm liable to pay something. That is, increase in liability should be credited. So business is going to come. For that, I'm liable to pay something. So business purchase account will be debited and we pay to the liquidator of vendor company. Okay. So I'm liable to pay to the, in accounting, we say liquidator of vendor company. I'm liable to pay to the liquidator. Liquidator is the person who is going to take care of the liquidation of the vendor company. So we give it to them, whatever we are liable to them. So first entry we are going to pass, business purchase account will be debited and liquidator of vendor account will be credited here. So what is going to happen? This amount, this entry should be passed by the PC. What is PC? Purchase consideration. So business is going to come. For that I am liable to pay. Okay. So business purchase account will be debited and liquidator of vendor account will be credited. Now remember this here. When I say PC, PC is very important. Every question, first we are going to calculate the amount of PC. Okay. So this entry we are going to pass with the amount of PC here. Okay. Now what happened now? I will take here the asset and liability of the vendor company. To understand this point, what is going to happen now? Okay. Now before I come to entry number 2, suppose that here now, I am to take here the asset of vendor company which is agreed at, let's say that here, the 50 crore. And the liability of vendor company is going to be as what? The 20 crore that here. So net asset I'm taking from the vendor company is 30. You agree that? Yes. Okay, now understand this point here. Now what is going to happen here now? Suppose, first of all, think from the purchasing company's point of view. We receive the asset. The basics of accounting say increase in asset should be debited. So let me write it down that here now. I receive the asset. You can see that here asset account should be debited. Here I have just written asset, but individually the name of asset they will give us in question. So we receive the asset. So I write it down 50 suppose. Agree? Yes. We also receive a liability. Increase in liability has a credit balance. So we have to credit to liability. So liability will be credited by how much here? 20. So net is coming how much here? 30. But suppose the amount of PC, let me say the amount of PC. Suppose the purchase consideration is decided 35. So don't you think so that here I am taking the net asset of 30, but for that we are giving how much? 35. It might be happen. The net asset which we are taking and the amount I am paying more or less, whatever it might, I am paying it more, 35. So the business for 30, I am giving them 35. So they say, first of all, asset account should be debited with the amount agreed value. Liability account should be credited with the agreed amount that here now. Now business has come in first entry when you debited here. So business purchase account is debited here. Now business has been received. So we have to cancel the business purchase account. So first entry, it is a due entry. Business is going to come. So we pass the entry here. Business purchase account should be debited here. And here business purchase account should be credited because we have received the business now. Is the amount of PC is here? 35 with the amount of PC. So we debited the business purchase with the amount of PC. We credited the business purchase with the amount of PC. Okay. Now they say here, these 2 points is very important. If my debit side gets short that here, they tell us that here we have to write it down as what? Goodwill. When if debit is short, I have to say that here. It is 50 here, correct. Credit is 20 and 35. That is coming 55. So my debit is getting short by how much here? 5. It is getting short by 5. So we are going to call it a goodwill, but it will be a balancing figure. It will be a balancing figure that here. Okay. Now, what happened that I pass the entry here now is asset account debit because I've received all the asset. I not necessarily all the asset. Okay, whatever asset, agreed value of the whatever asset mentioned in the question. Liabilities account credited with the agreed amount and business purchase cancelled. This is a balancing figure. Now let me tell you the logic why we call it a goodwill as per accounting standard 14. The asset that we have received from the vendor company 50, liability is 20, net asset is 30. But we are paying them 35. So we are paying more than the asset, net asset that they have received from the vendor company. So they say, why should we pay something more to anyone? So AS 14 has an argument here. They say we are paying more because they have a goodwill. Let's assume they have a goodwill, which is what AS 14 say. So I'm paying him instead of 30, I'm paying him more 35. That 5 will be considered as goodwill. So you will see that automatically this balancing figure will come as a 5. Let me change the situation now. Okay. Let me write it down with some other color. Okay. Now suppose I have taken an asset which is of same 50. Now let me say the liability which is of 20. So I am getting here net asset by how much? 30. Net asset I am getting of what? 30. So asset here is of 50, liability is of 20, net asset is of what? 30. But suppose the PC that I have calculated is coming only 28. Example 28. So it is, I am not paying additional amount. I am not paying additional amount. Instead of 30, I am paying a lesser amount. 28. So it's a benefit for me because the net asset which I am receiving from the vendor company, that is of 30. But how much I am paying to them? 28 only, suppose. So 2 is the less amount I am paying by 2. It's a benefit to me. And is it a revenue nature profit? It's a profit to me, purchasing company we are. It's a profit to us. But is it a revenue nature profit? No. It is not a revenue nature profit. It's a capital nature profit. So they say it should be transferred to capital reserve. The difference will automatically, if credit side gets short, let me write it down here. If I say asset received 50, so I debited the asset account by 50. You can see that asset debited by 50. Now liabilities here, again 20 here, 20. Now here business purchase is suppose how much is 28. So you will see that here now my debit side will not get short. My credit side will get short by 2. And if my credit side gets short, they say write it down as what? Capital reserve. So if my debit side gets short, I will write it down as goodwill balancing figure. If my credit side gets short, credit is short, I will call it as what? Capital reserve. What we will call it capital reserve. You got the point here? Because this profit, because instead of 30, I am paying 28 and it might be happening. My piece is any amount that here. So I am paying the less amount that here, which is 28 that here. So by 2, I am paying less. It's a benefit to me. It's a profit to me. But it's not a revenue nature profit. It's a capital nature profit. That's why we are going to transfer to capital reserve account. So the logic behind this. So first, you will pass into the PCDU. Business purchase account should be debited and liquidator of the vendor account will be credited. Second, asset and liability is taken over. So I will take all the assets, whatever assets, not all necessary all. Asset I will debit that here, whatever mentioned in question. Liability will credit and business purchase will I will cancel here. And if debit side gets short, I will do goodwill. If credit side gets short, I will call it capital reserve. Now, these account has been cancelled because in first entry business purchase debited, in second entry business purchase credited. Now in the first entry I have credited to the liquidator account. So when I say that here now, I credited, when I say that here now, liquidator to vendor, we are liable to pay. Now we receive the business, we are going to pay to the liquidator. So when I'm going to pay to the liquidator that here now, it's a liability. I'm discharging the liability here. So liquidator account will be debited with these, which amount here? With the amount of what? PC, because we pass the entry first with the PC. So I'm liable to pay. Now what we are liable to with the amount of PC? The PC amount will debit. What we are giving? We can give anything. We can give equity share, preference share, debenture, cash, anything. But remember that if I'm giving equity share, I will credit to equity share capital account. If I'm giving preference share capital, so I will credit to preference share capital. If I'm giving them debentures, I will credit to debenture. We can give anything that is. But always remember that equity share, preference share and debenture, it will always be recorded at face value. You know that here. The shares when we issue in the market, it might be at the face value, it might be at the premium, okay? But remember, even though we are giving these shares debenture at premium that here, still it will be recorded face value and the premium amount we are going to write it down in securities premium account. So suppose the share is of rupees 10, we are giving it 12. So share still be recorded at 10 only and 2 will be recorded as what? Premium. So always remember that here now, this securities premium account, premium amount will be recorded in securities premium account. If I am giving cash or buy bank or other asset. So I'm giving to liquidator, and liquidator account should be debited because it decreases in liability. No, and if I'm giving shares, whatever, that will be credited here. Now, very interesting point that here, if you see the first entry, you just for the understanding purpose I'm doing it. Don't do it in your repeat this book. Here in first entry, I debited the business purchase account, correct? In second entry, I credited, so my business purchase account get closed here. In first entry, I credited to liquidator account, and in third entry, I debited to liquidator account. So my liquidator account will also get what? Close here. Got the point here? But these three entry, it is mandatory in every question. These three entry is going to come that here. First, PC due, second, asset and liability taken over, and third, discharge of purchase consideration. So don't cut it in your book, just to explain you, I have done this. Okay. Now what is going to happen now here? Now first entry PC due, business purchase account debit to liquidator of vendor company that here now. Second company is that here now asset taken. So asset account should be debited, liability account will be credited, and business purchase account will be credited. If debit side gets short, goodwill, credit side get short, we call them capital reserve. I told you the logic behind these, okay. Now, third entry is discharge of PC. So liquidator of vendor account will be debited if you are giving them equity share. So to equity share, face value. If you are giving preference share, to preference share, face value. Debenture, face value. Whatever amount of premium, we'll write it down as two securities premium account. If you are giving cash or bank, to cash or bank. Or if you are giving any other asset, to other asset account. These three entries going to come in each and every question in the books of purchasing company. Okay. Now, I will come to these four entries that here now. But let's come this fourth number entry, fifth, sixth, and seventh, or in fact that here, when it will come in question that here now, let's take the fourth one. Okay. Now this point number 5th, 6th, and 7th in rapid GS it is mentioned. It is explained in detail that here. Later on point number 10 that here. Okay. Special transaction, intercompany statutory reserve, and these intercompany stocks. I will explain you in detail to you. Okay. Now let me come in entry number 4. Okay. Now remember that these 1, 2, 3 entries is going to come in every question that is. But in fourth entry, okay, now fourth entry, what it say that now, if any liquidation expenses of vendor company paid by the purchasing, certain time it happened that now there are certain liquidation expenses. The company is going to liquidate. They have certain expenses at the time of liquidation. If that is going to be bear by the purchasing company, the purchasing company is paying, and we are doing accounting in the books of purchasing company. So when I say that the purchasing company is going to pay, it might happen. Suppose you are a vendor company, you are going to liquidate now. So I'm going to acquiring your company. I will say, oh, don't worry, I will pay your amount. Okay. So when I pay, obviously we are doing accounting in the books of purchasing company. So I'm paying by cash or bank. So no doubt I will credit to cash or the bank account. Okay. Now, what should be debited? Now, you will tell me, sir, it is an expenses for you. So write it down as an expense. I say no. In fact, AS14 say no. Why? But I'm paying it that. They say no. So is it the expense of vendor company? Yes. So, but vendor company is going to liquidate now. Correct. So which account should be debited? This is not my expense. It's your expense. I am bearing your expenses that. So AS14 say, listen, the best idea is that in that is go to the entry number 2. I asked him why. They say just go to the entry number 2. Okay. What comes in your entry number 2, whether goodwill or capital reserve? I tell them when the goodwill is coming that here. Goodwill, suppose goodwill comes. So they say here goodwill account should be debited. I ask him why goodwill account should be debited. They say as you are paying the additional amount here, so you call it goodwill. So this liquidation expense also adjusts in goodwill only. If the capital reserve comes here, so they say, what is capital reserve? I tell him, it's a profit. I pay lesser amount. Instead of 30, I paid them 20. It's a profit. Okay. They say, okay, profit comes in second entry. I say, yes, that is capital reserve. Then they tell me that it does Zubair, if your profit comes in second entry, reduce the profit, adjust in capital reserve. So here, which account should be debited? It depends that here. If in the second entry goodwills come, the goodwill account should be debited. If in second entry capital reserve comes, the capital reserve account should be debited. So they say here, if goodwill in second entry, so goodwill account should be debited. If capital reserve in second entry means this entry, capital reserve should be debited here. This is what AS14 say. So the first three entries is very important. First three entries are very important because in every question we are going to pass in the books of purchasing company. PC due, asset and liability taken over, and discharge of purchase consideration. Okay. Now fourth entry is a liquidation expense given in question that now. So if in second entry goodwill, so goodwill account, then goodwill account will be debited, or capital reserve in second entry, and cash or bank will be credited. Don't worry about entry number 5th, 6th, and 7th. I will explain you when that will come in the question. I will explain you. Here in these marathon, I am to discuss each and every point, every discussion I am to do with you. Don't worry for that. Okay. Now understand this here. So these 5th, 6th and 7th, we'll discuss it later that. So these 4 entries are important, right? Till now I've discussed with you the how to calculate the amount of the PC that here now, and then accounting the books of purchasing company, and we have discussed just 4 entry that. Okay. Now please come to super 60 question that. Okay. Now come to that 50, sorry, super 50 question, not 60. Now come to question number 27 that here. Okay. Is it the right time to take question number 15? Yes. Okay. Done. Okay. Perfect. Okay. Now understand this one. Or can we take, let's go in sequence only. No problem. Okay. I'm just saying that. Is there any? Okay. No problem. Now come to question number 27 that now. Okay. The following are the summarized balance sheet of Well Limited and Nice Limited as at 31st March 2024. Just listen carefully. Okay. There are two companies, Well Limited and Nice Limited. Now they say here is equity and liability shareholders fund. In shareholders fund, share capital note 1, 41,000 rupees are in 1,000. Okay. 41,000, 14,300. Then reserve and surplus note to 19,500, 7,350. It is negative here. It means most probably it will be loss only. Okay. Now here, non-current liability long-term borrowing note 3, 20,500, 5,425. Current liability trade payable 15,750, 4,850. Short-term borrowing dash and 1,975. Total this is the amount. Now asset side here. Okay. Now asset side here, I will tell you the approach and all that. Just listen carefully. Okay. Now it says that here, when we talk about the asset that here, they say non-current asset PP note for this amount 62,550 and 16,380. Non-current investment 22,500 dash. Current, this non-current asset, this current asset. Inventory 300, 850. Trade receivables 6,590 and 1,950. Cash and cash in 4,800 dash total. Now they have given the detailed notes to account. Okay, here equity share capital issued, subscribed and paid up capital equity share rupees 100 each. 31,500, 12,500 preference share capital. Now issued, subscribed and paid up 9% preference share offer with 100 each. Then 10% preference share offer with 100 each. These are the amounts. Now reserve and surplus balance of profit and loss 19,500 is negative. It means it's a loss. It's a loss. Now here, then they have here is the long-term the borrowings. Okay, long-term borrowings here. 9% debenture offer with 100 each 11,200, 10% debenture offer with 100 each 900, loan from bank 9,300, 4,525. Now they have given, they use the word here in on asset side here, on liability side and asset side trade payable. You can see the trade payable and asset side trade receivable. Basically trade payable means here is creditors and bills payable. And trade receivable is a combination of debtors. Okay. Some people call it debtors. Same thing. Okay. Debtors and bills receivable. Okay. So you can see that they have given us the bifurcation of these amount here. As trade receivable is 6,590. 6,590. So what happened here? They give us the bifurcation. 6,200 is of the debtors here. You can see that here now. And here is the bills receivable. This is a total 6,590 here. Now here trade receivable debtors is 1,800 here now, and bills receivable is 150. Okay, this is the amount. Now trade payable, when we have trade payable. Okay, then we have a trade payable. So you can see that they have given us the detail of trade payable. Trade payable is how much? This is the amount 15,740 and 4,850. So they give us the detail that here, creditors that here, this is the amount, and bills payable, this is the amount, this is the total. Okay, it will match there. Now they tell us that on 31st of March 2024, so the balance sheet which is given here on 31st March 2024 only. Okay. Now they say Nice Limited will absorb the business of Well Limited on the following terms. Point number 1. Nice Limited is a Nice Limited. They're absorbing to Well Limited. What is the case here? Amalgamation or absorption? Come on. Amalgamation or absorption? Amalgamation. Why? Because one existing company taking over another existing company. It's the case of absorption. Sorry, amalgamation. Sorry, absorption. Okay, not amalgamation. When company will take over another business, we call them absorption. When two companies come together to form a new company, we call them amalgamation. It's an absorption. It's a purchasing company and it's a vendor company. It's a purchasing company and this is what? The vendor company. So one is the purchasing company and one is the what? Vendor companies. Okay, now here, understand this one. So always remember that first is to find it to the amount of PC, because without PC you cannot do anything in question that here. So I will come to all these points, but they say you are required to record the journal entries in the books of NICE Limited. NICE Limited is a purchasing company. So we are going to record in the books of purchasing company. Okay, we are doing the accounting in the books of purchasing company, and they ask you directly to prepare the entries and then balance sheet after absorption on 31st March 24. So in the books of the purchasing company, the balance sheet, we will prepare, we'll discuss that here. But before we come here with that, to record the entries in the books of purchasing company and to prepare the balance sheet after the absorption, what we have to do first, we have to here, we have to here find the amount of PC. Do remember that I told you that anything we are giving to shareholder, that is the amount that will be considered as a PC. Okay, then I will come to entries. So let's see that here one by one. First point, they say for every 5 equity shares held by the equity shareholder of Well Limited, means vendor company, they will receive 3 equity shares of NICE Limited issued at a premium of ₹20 per share. Now they say for every 5 equity shares, okay, I will give them, they will receive 3. So for vendor company, for every 5 share, I will give them 3 shares, okay, at a premium of ₹20 per share. How we can, now we are giving to the shareholder. First of all, we are giving to the shareholder of what? The vendor company. So we are giving to the shareholder of vendor company. So this is it will be considered when we calculate the amount of PC. This is point number 1. Now what happened that here now? When I say we are giving to the shareholder, it is the amount of PC. Point number 1. Point number 2 is that here now, when I say that we are giving to the shareholder of vendor company, but how much, what we are giving? They say for every 3 shares, for every 5 shares, we are giving them 3 shares. So how many shares they have? And we are giving them at a premium of 20. Okay. But how many shares they have? So when I go to this vendor company Well Limited, so share capital, note stock number, equity share capital. So 12,500. Remember that this is rupees in thousand. So at 3 zeros already. Okay. So it will come here is 1 crore 25 lakh. If you add this 1 crore 25 lakh divided by 100. So they have 1,25,000 shares. So when I say that here now, 1 lakh, or you can see if you want to make it simple, simply you can say 12,500 and rupees in thousand divided by 100, that is coming 125. So 125, that is also in thousand. So 125,000 shares they have. Okay. So for every 5 shares, we are giving them, we are giving them 3. So 125, I will say, okay. 120, you can see that here. 125, wait, I have to just give me a minute here. Yes. So for 125 that here, okay, they have given, okay. For 125 here to the equity shareholder, we are giving them, let me write it for 125,000 shares that they have, okay. 125,000 shares they have. For every 5 shares, I am giving them how many shares here? 3 shares, beta. And at what price? 100 is a face value. I am giving them 20 rupees premium. So I am giving them at 120. So 125,000 divided by here 5 multiplied by 3 multiplied by 120. That is coming 90 lakhs. So we are giving them 90 lakhs shares of rupees 90 lakh. Okay. It is a normal figure, but when you write it down in balance sheet in thousand only, it will remove this 30. Okay. Now they say here, the first point done that here now, this is the first point. Okay. Now what happened? Now always remember that one thing. It is a marathon, but I want to make it very interesting for you that here. Okay. Everything I want to discuss in detail that here, because after this marathon, you should feel that every concept you have understood each and every concept properly that here. Okay. Now what happened when you have to pass the entry? I told you that here, that if I am to pass here on face, share capital will always be in a face value. Premium amount will go in securities premium. So this 20 is premium. So you can see that here now. If I want to, you can also write it down like that. No problem if you have written, no problem. Don't change it. I am saying 125,000 is the number of shares that they have. For every 5 shares, I am giving them 3. If I multiply by 100, that is share capital. It will go share capital. Okay. And if I say, or you can say that here now, or you can say like this, 120 is the, but here 100 will go to capital and 20 will go to premium. I told you that here. Always face value will go in equity share capital. Okay, always remember that. Okay. So when we'll pass the entry, we remember the 100, we have to 125,000 divided by 5 multiply by 3 multiply by 100 will go to capital, and here multiply by 20 will go to securities premium. Okay. Now here, point number 2, they are giving the 10% debenture holder of well limited where to be allotted. So they're talking the debenture holder. So if they're giving to debenture holder, I don't care. I will discuss with them later. We'll do the settlement with them, but that is not a part of PC. Now third, they say that now 10% preference shareholder. Now we are giving to preference shareholder. So whatever we are giving to shareholder, that is a part of what amount of PC. So 10% preference shareholder of well limited are to be paid at 10% discount by issue of 9% preference share at par. So basically they are saying the preference shareholder of vendor company, I am taking it a lesser value by 10%, and in return I will give them the shares of my company at par. What does it mean? Let me explain you that. When I go to the preference shareholder amount here, in notes to account number 1, I find it out that here they have a preference shareholder of 1,800. It is in 1,000. Okay. It means 18 lakh. So what happened that now? I will say that here now, how we calculate that here. So I will say that here 18 lakh is the amount that they have. I am taking 10% lesser value. So 18 lakh minus how much here? Minus 10%. So that is going to come how much is 16 lakh 20,000 that year. So I am giving them the preference at par only. Okay, I will issue them the shares at par 100 only. So I have to give them the shares of 16 lakh 20,000 and I am giving them shares at par. It is mentioned in question. So divided by 100, that is going to come 16,200 shares I am giving of rupees 100. That is some 16 lakh 20,000. If we do the total will come here 1 crore 6 lakh 20,000. That is the amount of PC. What is this? This is what they have mentioned about the preference shares that here. This 18 lakh minus 10%, 16 lakh 20,000 is shares of rupees 100. So divided by 100, so 16,200 multiply by 100, that will come 16 lakh 20,000. You got the point here now? This is the amount of preference shares. This is the amount of equity shares. Okay. Now, this is the challenge. We have always find it out first amount of PC. Once we find it out the amount of PC, then it is very easy for us that here. Okay. Now, what happened that here now? Now, we will discuss, I will discuss all the, what should be the approach that here. So in examination, what should be your approach that here? First, you have to find it out the amount of PC. We find it the amount of PC here. Now, read and every transaction and give the some, I'm going to say mark in balance. I tell you why. The first approach to find the amount of PC, correct. Then they say the debenture, the 10% debenture, something they're talking about debenture. We'll discuss them, but this is something they're talking about debenture. So what I will do that of vendor company, obviously. So I will do the here debenture, the vendor company, this is a debenture. Okay, because there's some adjustment. They have not given the numbers here. So always I can give the reference also. Third point and fourth, bank agreed to waive off the loan of rupees 270,000 of well limited. Something is mentioned about the bank loan that we have taken, this bank loan. Okay. Now here, then expenses of liquidation of well limited are to be reimbursed by Nice Limited of rupees 55,000. So liquidation expense. Okay. Inventory of well limited is to be taken over at 10% more than the book value by Nice Limited. So inventory of inventory, something is mentioned. Okay. Now here, debtors of Nice Limited include rupees 215,000 receivable from well. So debtors here. Debtors here. Debtors. Okay. Then here. Then they say that here now. Debtors on. Okay. Wait. Debtors of Nice Limited. Here. This. Okay. No problem. Or you can say debtors of Nice Limited. It means debtors of Nice Limited. I will explain you that here. Include rupees 215,000 receivable from well. So for well, it is basically a payable, trade payable. So you can see that this is a payable for them. Trade payable. I will discuss with you. Don't worry. Very simple. That. What is this? I will tell you. Don't worry. Simple. We call them mutual debt here. Then they have PP, property, plant and equipment of well limited are valued, revalued at 20% above their book value. Okay. Now what is PP here? Above their book value. So I will write it on your PP. I will do the star mark in PP. Is there notes on PP? No. No problem. Oh, notes number 4 we have. Where is notes number 4? Oh. Wait here. There is no notes on number 4. Okay, anyways, they have written the PP only. So let me write a PP here only. Okay, star mark. Notes number 4 is not mentioned there. Okay, let me assume that here there is no bifurcation. If there is a bifurcation in PP, it might happen. They will give the bifurcation of land, building, plant and machinery like that. But PP they use means they all are combined there. No problem. The remaining asset and liability are to be taken at what? The book value. So is it the case of amalgamation nature of merger? No. Why? Because they're changing the value of almost all assets here. Take PP at this value, inventory as this value. They're changing the figures there. Okay. It means it is not a case of amalgamation nature of merger. It is a case of amalgamation nature of purchase. So first we find it out amount of PC. Then what we have done, first we find it amount of PC. Then what we have done that here now, we have find it out now here, after the amount of PC. Now we are going to pass the entry. So we know the approach that here, whenever the adjustment is given, we have written down. How we have find it amount of PC? Because it is clearly mentioned for every 5 shares, give them 3 like that here. So we find it out the amount of PC by payment basis, not by net asset basis. If nothing is mentioned that is, then we have to calculate the amount of PC by net asset basis. That also we are going to solve. Okay, other questions will come. Don't worry. Now I discuss with you about accounting entries one by one. What we'll do that is, now one by one we'll pass an entry there. So you can see that first entry what we pass, purchase consideration due, PC due. Okay. So what entry we pass? Business purchase account debit to liquidator of vendor company. So here we'll pass first entry in the books of purchasing company. Okay. That business purchase account debit to liquidator of vendor company. What is the name of vendor company here? Is Well Limited. Okay. So what is the amount of the PC that here now? The amount of PC that we calculate is how much? 1 crore 6,20,000. So in thousand, just we have to write it down. Remove the 30 that here. Okay. So this is the amount of PC. So purchase consideration, business purchase account debit to liquidator of vendor company. Okay. Now remember that. Now what is second entry we pass here? Second entry we pass here. Assets and liabilities taken over. So when I say assets and liability taken over, what entry will pass? I will debit to all the assets. But at what price we are going to take? At agreed value. Okay, so step number 1, calculate the amount of PC, then start passing the entries there. Okay, now asset account debited at agreed price. So I will write it down asset one by one. So here we are talking the vendor company asset we are taking. Okay, so here asset side you can see that here property, plant and equipment. But they tell us that something is mentioned about the PP. So when I go to the question that they tell me that here about the PP here. You can see that property, plant and equipment of Well Limited are to be valued 20% above their book value. So what is the agreed amount here? We are taking the asset of vendor company 20% above the book value. So the book value is how much? Is 16,380. So what we'll do that here now? You can see that property, plant and equipment account should be debited here. That is here 16,380 plus 20% or multiply by 120%. So this is the agreed amount. Then the second asset that they have here is inventory. Something is mentioned about the inventory as well because we have marked there. So I will go to the question that is inventory. Inventory of Well Limited is taken at 10% more than their book value. So we have to increase the value by how much here? 10%. So the value here is that here 870. So what I will do that here now? 870 plus 10%, that will come 957 here. Now trade receivable that here, but trade receivable that here now, here I will go to the detail is given here. So that here debtors is 1,800, debtors is 1,800 that here. Okay, one more thing is that here now, when you talk about the debtors and then bills receivable, okay, they have not bifurcated there, but okay, that 1,800 plus 150, they write it on trade receivable only, 1950. Alternatively, you can also write it down here as debtors 1,800 and bills receivable 150. That is also okay. Okay. Then here, no cash and cash equivalent. So we recorded all the assets there. Okay. Now what we'll do that here, we'll write it down the all liabilities there. Okay. So this is what we have done. We have recorded all the assets here. If the difference will come on debit, we'll write it down as goodwill. If on credit, we'll write it down as what? Capital reserve. So liabilities here. Okay. Liabilities here. So when it comes to liabilities here, what is going to happen that here now? One by one. Liability means outside liability. Okay. So this is current. You can see the long-term borrowing, notes to account number 3. So I will go to notes to account number 3 one by one. Now we have here is the vendor company, that is 10% debenture is 900. Now let me tell you one thing is that here. I agree. They say in the, okay, let's say the debenture. They say in case of a debenture that here now, is the 10% debenture holder of Well Limited were to be allotted 9% debenture in Nice Limited as would be the same amount of interest that year. So I will first of all that how much is the amount that they have mentioned there, how much is the amount here of the debtors here that is coming here, how much? 900 here. Okay. Now understand this point here. What is going to happen that here now? Let me write it down there, but they have how much they have write it down here, debenture holder is the 1,000. Now, how they have calculated these 1000? Now, please understand this here. Read this question carefully. At what price we are taking the debenture here? So they are saying that here the 10% debenture holder of well limited that here. Okay, what happened? Okay, 10% debenture of well limited that here now. Where to be allotted here? 9%. Okay, 9% debenture in nice limit as would bring the same amount of what? The interest. I think it is, yes, proper now. Now understand this one. What it says that here, the 10% debenture holder of well limited. If you see that here, the 10% debenture of well limited, you can see the 10% debenture that here now of well limited is a vendor company. How much debenture they have? 900. Okay. So this says that here the 10% debenture holder of well limited where to be allotted 9% debenture. So what the purchasing company will do that here now, they will take this 10% debenture, but to them they will allot what? 9% debenture as would bring the same amount of interest. But the debenture of vendor company should get the same amount of interest. What does it mean? Let me write it down here. Okay. Now they have a debenture of how much? I think 900. Yes, correct. They have a debenture of how much here? The 900. Okay. Now if you take the 10% of that, that is coming how much? 90. Okay. So what they're saying that here, suppose you're a vendor company and you're a debenture holder of vendor company. You are getting 90 as an interest on debenture. Correct. So, but they say these 10% debenture will be converted into 9% debenture, but you will get the same amount of interest. How much you're getting the interest now? That is 90 only. You got the point? So what is going to happen here now? If you're getting the 90 as an interest on debenture, the same amount of interest you should get when you will be converted into debenture of a purchasing company. Okay. But how much interest I will give? 9% on. But amount should be same. Amount should be same. You will get the 90 as amount of interest, but the percentage will be 9% here. Why? Because this 10% debenture will be converted into 9% debenture. So how much debenture should I issue? Divided by 9%, or you can say 90 divided by 9 multiplied by 100 that here. So that will come here 90 divided by 9%. That will come how much? 1000. So I am getting this debenture of a vendor company of 900 at what price? At 1000. Now you will say why, sir? Because they tell us in the question that here, but in the both the situation you will get the same amount of interest. Let me tell you that. How much currently you are getting? 900 multiplied by 10%. How much? 90. How much I will give you? 9%. But if I get 10,000 multiplied by 9%, it will come 90 only. You understand this? Or you can say that this much amount of interest you are getting now. 900 multiplied by 10%, that is 90. Here in new company also you get 90, but the amount of interest will be 10%. So this is question mark. You got the point. So this should be how much here? The 1000 that here. Okay. So I'm taking the debenture at 1000 here. So you will see that here debenture holder at what? 1000. Okay. Now we'll convert it later on, but this is one more thing that here. When we calculate the amount of PC, we say on what we are paying to the shareholder, that is the amount of PC. So whatever we are paying to the shareholder of vendor company only, that will be considered as the amount of PC here. But here we are talking debenture holder. So at whatever agreed value, whether it's any asset, any liability, whatever is the agreed value, we have to take the asset or liability at that value only. As they are changing the agreed value is different for the here the PP, they have changed the value like the inventory, like that only for the debenture. Instead of 900, we are taking it what? The 1000 here. Okay. Now, what happened now? They say after this we have go to the balance sheet again. Okay. Go to the balance sheet again. So we discuss about here now is the debenture, non-current liability. No, few more liabilities we have. Okay. This one also we have. Now here the loan from bank 4525, but something is mentioned about that. If you go to the next point, this point, okay, they have not given the numbers, but if for reference, you can give the number also there. Suppose 1, 2, 3 was given. So like that, you can give the reference here, 1, 2 like that. Okay. Now here, they say bank agreed to waive off the loan of 270,000. So 270,000, they are agreed to waive off by the bank. So 4525 minus 270. You can see that here. 4525 minus 270. How much is 4255? So we are getting the loan from bank at 425. We have already taken the loan. I mean, the vendor company. Now we are taking this liability minus 270 because bank is going to waive off 270. Okay, this is the amount that they have. Now here, if you go to the balance sheet here again, what is the next liability that you have here? Is it trade payable? So trade payable that here, they have given the details. You can write it on 4850 also that here. Okay. So here, I think they have write it on like that 4850. Okay. Trade payable. Yes, 48. You can see that 4850. Okay. Now there is a concept of mutual debt. I will come to that. But mutual debt always we have to do the adjustment later on. First, we have to take the asset and liability agreed value. Whatever amount is agreed, we have to take at that value. You got the point here now? Okay. Now, do we have any other liability of the vendor company that we are taking? Yes. Short-term borrowing is 1975. No adjustment on that. So we'll write 1975. So what we have done that here, we recorded all the asset at agreed value. We have recorded all the liabilities at what? Agreed value that here now. Now, in first entry, we debited to business purchase account. What we'll do that now? We have to credit to them to cancel them because we have received the business now. So what we'll do that here now? We will credit to business purchase account. If you see that here in your first entry, there is 10,620. Here it is coming 10,620. We'll cancel them. Now what we have to do? We have to do the difference between the debit and credit. Here in this question, if you do the total of these credits first, all these items, deduct all the debit items. So debit side is getting short by 137. So I told you that if debit side gets short, we will debit to goodwill account. If credit side gets short, we will debit credit to capital reserve account. Okay, here in our exam question, the debit side gets short, so it will be debited by 137. That 137 is nothing but a balancing figure. So we have passed to entry. First, this entry PC due, asset and liability taken on. Third one is the discharge of PC. Discharge of PC. Okay. Now, what entry do we pass? Liquidator of vendor company. 2. Whatever the face value will come to share capital face value. Here come preferential. But premium will come to securities premium. If I go to the calculation of PC, remember that for the equity shareholder, I told you that here 125,000 divided by 3 divided by 5 multiplied by 3. For every 5 share, we are giving them 3. Okay, so 125,000 divided by 5 multiplied by 3. That is coming 75,000 shares. Multiply by 100 for the face value. So multiply by 100, that will come 7,50,000. So here in rupees in 1,000, 7,500. Okay. Now how they have calculated this? 125,000 is that in 1,000 I have written share. For every 5, I am giving them 3. Face value is 100. Here, premium if I say 125 divided by 5 multiplied by 3, premium is 20. So 125 divided by 5 multiplied by 3 multiplied by 100. Okay. Then 125 divided by 5 multiplied by 3 to multiply by 20. Okay. Just 1 minute. Divided by 5 multiplied by 3 multiplied by 20. Yes, this amount. Okay. So premium amount will come in securities premium account and face value will come in capital. Now what about the preferentials? Please don't get confused that here. They have reduced the value at the time of acquisition. Instead of 18 lakh, they have taken it 16 lakh 20. But they are issuing the shares at par only, 100 only. It is mentioned in question. So that is coming 16 lakh 20,000. If we write it down that in thousands, so 1620. 1620. So liquidator of vendor company account will be debited with the amount of PC and whatever we are giving will credit them. So we pass the main 3 entry I told you that here. First, acquisition of PC due, asset and liability taken over and discharge of purchase consideration. Correct. Now we'll come to the next entry. Now any point left here, look at in the question that now. Okay. For these debenture, I will discuss one more thing. Now, first done, here done. Okay, this entry now, this left. Expense of liquidation of this vendor company, well limited, are to be reimbursed by the NICE. So we are paying the 55,000 that is. I told you that we have to look at the second entry. In second entry, we have what? Goodwill. So we are going to pass entry goodwill account debit to bank account. To remember this here, second entry, if goodwill in second entry, then goodwill. Capital reserve second entry, then capital reserve. So goodwill account debit to bank. The last they have passed here at the end. Okay, goodwill account debit to bank. Simple, very simple. You are going to get the 14 out of 14. Trust me, you are going to get 14 out of 14 in examination. Just know, you should know the approach here. Okay. Now, certain more thing that they have given that I want to discuss with you. I will come to last point here. Okay, I will come to this last point here later on that here now. This pending. Okay, I will come to that now. Okay, no, that is also done. Because it is mentioned that here, all remaining in asset and liability of vendor company taken at the book value. This is also covered. Okay, we have taken the remaining asset at book value. Okay, this is pending. I will come to this. But remember that here, debenture holder have to be converted now. You will say, why, sir? Here, instead of writing out debenture holder, it's both are correct. You can write it down here at the 10% debenture also. It was 10% debenture. Okay. Now here, 10% debenture account will be debited. Why? Very simple basics of account. We took a debenture at 1000, 10% debenture. We have to convert them into 9% debenture. So 10% debenture account will be debited. It is going to cancel. So I'm going to debit a 10% debenture account will be debited here, and 9% debenture account will be credited here. You got the point here now? So 10% debenture account debited and 9% debenture account credited. Or what they have done here, they credited to debenture holder account. That is also correct. We are liable to pay to debenture holder 1000. Then that will be cancelled here. Debenture, that 1000 will be cancelled because we are giving them new debenture by the purchasing company 9% debenture. This is the entry. Decrease in liability should be debited. Increase in liability should be credited. Decrease in liability debited here, that is 10% debenture, and increase in liability credited here by 9% debenture. But how we find it out the amount of 1000? Very simple. I told you that how we find it out this amount of 1000 that here now is the debenture was 900 of vendor company. They were giving them 10% interest, that is coming 90. Same amount of interest we have to give them in a new company, but the rate of interest is 9%. It means this 90 is 9. How much will be 100? That will come in 1000. Simple. Okay. This is how we find it out this amount here. Okay. This is how we find it out this amount 1000. Okay. Done. Now, one thing that we have done with all entries we have done. Okay. Now, one thing is that new that I want to teach you that here now is this point, intercompany dues that. What is this intercompany dues that you understand this point here? What happened that here? I am a purchasing company, you are a vendor company. Understand the logic here. So when acquire your company that here, what is going to happen when acquire your company? Certain thing is suppose is payable or receivable between each other. So what is going to happen? Now imagine a balance sheet. It is also mentioned in detail that here. In rapid G's that here, in point number 10 that here. Okay, point number 10, this special transaction are the intercompany dues that I want to discuss with you. Now let me tell you what is the logic behind this. Okay, very simple that now. If I say one company, purchasing company, one company, vendor company, you will understand the logic. Very simple that here. It's a purchasing company, it's a vendor company. In your balance sheet that here, in your balance sheet, suppose, let me take the same example here. Okay. Okay. In your balance sheet now, this is a liability you are liable to pay to liabilities. Suppose you are liable to pay that here now. Is suppose here, how much is, suppose 215 that here. And to whom you are liable to pay? To the purchase. You are a vendor company. Suppose you have purchased something, whatever, but you are liable to pay me 215. How much you are liable to pay? 215. It will write it on my asset side as a receivable of 215. But what happened when we become a one company only that is? Because I absorb your company, I purchase your company. So it was payable by you to me and it is receivable to me from you that year. So when we make a one company when I acquire your company in my balance sheet, receivable from you is 215, and now I acquire your liability. In that liability here, payable will also come, that is that liability of 215. Now when I acquire your company, we are one company now. Now payable and receivable is a one party only that here. So it was recorded in your books of account as a liability liable to pay 215. The same thing which is appearing in my books of account 215. Now we merge the company. Now we are going to make a one balance sheet, receivable and payable. Okay, so on asset side, receivable, on liability, payable. So from whom it is receivable? That the vendor company. Now we acquire the vendor company. Now we are only the vendor company. We are the same company now. To whom it is liable to the damn. Okay, you got the point. It was liable to pay to the purchasing company now. Okay, so it was receivable from a vendor company. Whatever is that? Anything about receivable, payable between the purchasing and vendor company when you acquire the company, it should be cancelled out. Now it is a one company only that. So how it can be possible that the receivable and payable is to the one company only that here? So it's a mutual debt we call them. Okay, intercompany transaction that has to be cancelled here. So now if we pass that, what they say that here in question, they tell us that now debtors of NICE. Who is NICE purchasing company? So debtor of NICE Limited include 215,000 receivable from well. So debtors, it means I am purchasing your vendor. So receivable from me, you are liable to pay to me. But when I acquire your company, we become one company only. Receivable payable to same company because we are one company only. So we have to cancel them here. So simple. How are we to pass the entry? How are we going to pass the entry that here now? It's mentioned that simple. How are we to pass the entry? Decrease in liability. That's the basics of accounting is very important. That decrease in liability should be debited there. So you are going to debit the creditor account and decrease in asset. Creditor will cancel. Credit is the liability. Decrease in liability should be debited. Now, debtor is the asset. Decrease in asset should be credited. Sorry, decrease in liability should be debited. So decrease, we cancel the creditor. Creditor is credit balance. Now we are cancelling them, we have to debit them. The debtor is asset, asset and debit balance, we have to cancel, we have to credit them here. So we are going to pass entry here now. Creditor account debit to debtor's account. This is what they have mentioned that now. After the takeover, if there are mutual debt between the purchasing company and the vendor company, the purchasing company will cancel equal amount of in debtors and creditor of bills receivable payable through a special entry in its books. So creditor account debit to debtor's account. So this is what we have discussed, this intercompany creditor account debit to debtor, or if it is bills payable, bills receivable, whatever. So you can see that now there is a mutual debt of 215. So they have passed entry creditor account debit to debtor's account 215. You know how simple it is that here. Very simple. It will be a long marathon that here, but you will enjoy it because I am to discuss each and every concept of this amalgamation chapter with you. So they ask us to prepare the to pass the journal entry that we have done. Okay. Now these points also here pending. I will discuss with you when the time comes. That you can statutory reserve unrealized profit. Now very important point I am discussing with you. Very, very, very important point. Okay. Now listen carefully. They ask us to prepare the balance sheet. Okay. When it's come to the balance sheet now, I am a purchasing company. Purchasing company. Understand the logic here. And there is a vendor company here. It is a case of absorption. I want to become an expert in accounting. I don't want to, I'm going to say that here. This is shallow. No, you have to in-depth knowledge you should have. Okay, now understand. I'm a purchasing company. You are a vendor company. Okay. I acquire your company. I acquire your company. So what is going to happen when I acquire your company that here now? When I acquire your company that here now, it means I have taken your assets and liability. Correct that? Yes. So I am a purchasing company and I am an existing company. I am an existing company. Correct that? Okay. So when after absorption, when I am to prepare the balance sheet, I have existing balance sheet because I am an existing company. So there is one balance sheet which is given in question of the Nice Limited, which is a purchasing company. So I have a Nice Limited, which is a purchasing company. Okay, Nice Limited is a purchasing company. You got the point that now? And I acquire an asset and liability that I will merge in my figure and will make a proper balance sheet after the acquisition. But you have to do the basics of accounting, which is very important that here now. Okay. Now what happened here? Always remember that what I'm writing down here is very important. This is what we have. I have covered in the, just give me a minute, that now is in the, okay, in a regular batch here or the EO batch which is going on that here. I mentioned them all these points. The basics of accounting is very important that now. Now understand what I'm talking about here now. This is what I'm talking about now. Okay. Always remember that now. Debit should be plus. Debit credit minus. Credit plus. Credit minus. It's the maths. Okay, debit and credit is nothing but the math. So debit plus, debit credit minus, credit plus, credit debit minus that. Now understand this here. Now what is going to happen? Now it is important what is written. Let me copy paste there. Let me copy paste there. Okay, let me, where should I, okay. Okay, now understand this here. Okay, now understand this here. Okay, now please understand. What is going to happen that here now is that here now. I have the balance sheet here. Okay. I have a balance sheet. Okay. Now is, okay, so when first time it will take, but you will understand. Let me change the color here. Okay. Now, share capital, I will go to notes to account number 1, 41,000. Okay, notes to account number 1. I have 31,500 to write down, type in Calci that here. Type in Calci 31,500. Please type 31,500. Okay. Now, liability, equity and capital equity here. These are credit balance. All assets is debit balance. Yeah? Okay. So credit is a credit balance. Credit will always be plus. Now first is 31,500. I will go to the journal entries that here. When I pass the journal entries there now, you can see that here now whether yes, equity share capital you can see 7,500. And add in Calci, we have credited here. For the basics of accounting, equity has credit balance. We are crediting here. Credit should be plus. So plus 7,500. It is coming 39,000. So you can see that here in balance sheet here, notes to account number 1, 39,000. Okay. Now understand this one point. Always remember that here, these are in 1,000. Okay. 3,90,000 equity share offer is 100. Okay. But always remember that if you, yes, financial statement of company chapter, we have already done that here. Okay. Anything which is the issue other than cash consideration, that has to be mentioned separately as per Schedule 3. So this 75,000 share that we issue to the vendor company equity share, that is other than cash consideration, because we acquire the business, we give them shares that. Okay, so that have to be mentioned as per Schedule 3. So that they have mentioned inner column. Okay. Now again go to balance sheet here now. Okay, again go to balance sheet here now. In my balance sheet here, how much is the preferential capital? I have 9,500. Type 9,500. Type in calculation 9,500, 9%. Okay. Now go to journal entries that here. So we have credited 9% preferential capital 1620 plus 1620. That is coming 11120. So you can see that here in balance sheet here, notes to account number 1. 11120. How simple it is that here. Okay. This is total. So this much amount of share we have given other than cash consideration, that has to be mentioned in your column. The total amount of these share capital 50,120. Just write to 50,120. Okay. So simple. Now again come to balance sheet now. Again come to balance sheet. Now second is that here now reserve and surplus, notes to account number 2. The notes to account number 2, reserve and surplus, I have a profit of 19,500. 19,500. Go to journal entries that here now. Journal entries that here, any profit entry there? No. So 19,500. So in balance sheet, notes to account number, you can see that reserve and surplus 19,500. These reserve and surplus that here now, okay, basically should be profit and loss account balance. Profit and, okay, 19,500. Now again go to here balance sheet here now. Again go to balance sheet. That is what the balance of profit and loss. Okay. Now notes to account number 3, 20,500. Now notes to account number 3, one by one. So I will go to 9% debentures. 11,200. Type in calc 11,200, 9% debenture. Journal entries. Debenture, you have debited this debenture by 1,000. Sorry, credited, then you have debited. That gets cancelled. Okay, it gets cancelled. You credited here and then you debited here. It's get cancelled. But you have credited again 9% debenture. So plus 1,000. That is coming 12,200. So here you can see that here now. Notes to account number 3. We have not yet done with the notes to account number 2. The securities premium will come. You can see 12,200. So easy. Okay. Now, after this we have here now is trade payable. How much? Type in calci 15,740. Okay. Now here, when I go to journal entries that here. Okay. Journal entries that here. Not trade payable that here. Okay. Trade payable is how much? 4850 plus 4850. That is coming 20,590. But remember that here creditor is also trade payable. So we have to deduct. Why we are deducting that? Because we are debiting them. Please, basics of accounting is very important for all these advanced chapters. Creditor is a liability. Liability is credit balance. Now I am debiting it. Don't forget these basics here. Okay. Don't forget these basics here. Okay. It is very important. They have a credit balance. That is, now I am debiting them here. Okay. Credit balance that they have here. Okay. The credit balance they have. And I'm debiting them, we have to deduct that. These are basics of accounting. Okay. Now, so many people telling me that, sir, make a separate series for the basics of accounting. Yes, I will come with that. Okay. But here, I have to deduct 215. So we'll deduct 215 minus 215. That is 720,375. So notes to account is 20. Just 1 minute, that trade payable. 20. What happened? Yes, 2037. Outer column that like that they have mentioned. No problem. Okay. Now, one more is that is long-term borrowing. I forget to, that is a long-term borrowing. One more we have in notes to account that here now, which is that here how much is the loan from bank. 9,300 is a loan from bank that here now. Okay. Now loan from bank here now is how much? 9,300. So we have taken loan from bank. Yes. 4255. Okay. 4255. You can see that in 4255 here. Okay. So plus 4255, that will come 13,555. So here 13,550. You will never do mistake. Just follow this instruction that here. Okay. Now, again, we'll go to balance sheet here now. And they tell us that here, how much is the amount that here now in balance sheet here. After this trade done liability side, asset side now. PP is 62,550. 62,550. Okay. Go to balance sheet here now. Now entries here. So here PP is 19,000 plus 19,656. That is coming 82,202. So PP is 82,202. Okay, 82,206. Sorry, not 2. 206 is coming. Okay. Then we have here. Now is here is here non-current 22,500, no change in that. Write down in balance sheet here 22,500. Okay, 22,500 there. Okay, I will tell you about all these intangible and all that. Don't worry for that. First, do the balance sheet here. Okay, then inventory is 300. So 300 plus we have taken their inventory at what price? 957 plus 957. 1257. 1257. 1257. How simple. Okay. Then we have here, after this we have here trade receivable. So 6590. 6590 trade receivable that here. Okay. So here 6590 plus 1950. Debtors is debit, asset is debit balance. Okay. So plus debit plus. Now if we have credited here, so we have to minus them. Okay. Because debtors is asset debit balance. We are crediting, we have to minus them. Minus here 215. That is coming 8325. 8325. So simple. Okay. Now here next one is better. Cash and cash equivalent 4,800. So that is same. There is no cash and cash equivalent vendor company. So 4,000. Wait. Whether any yes. Go to entries. One payment is there. 55. So we have to deduct. Why we have to deduct? Asset. Asset is debit balance. We are crediting to bank. So we have to deduct 82570. Why the difference is coming? 55. Is there one more bank entry anywhere? Bank balance. Whether we have paid, just give me a minute that here. Okay, just let me take it again that. How much we have here? 4,800. Okay, cash and cash equivalent. And here we have credited minus 55. 4745. How much is? Yes, 4745. Sorry. Okay, 4745. Not done with all the items of balance sheet. Okay, now first calculate PC, pass the journal entries. Now here when we are preparing balance sheet, take all the items of balance sheet. Okay, now what happened here? Now understand this point here. We have to see any item which is left in this journal entry. Here we debited business purchase, but we credited business purchase, that get cancelled here. Okay. Now he credited liquidator here, but we debited here liquidator, so that gets what? Cancelled here. Okay. Now goodwill is there. So goodwill is there. How much here? 137. We have not yet recorded. Goodwill is intangible asset. Write down in balance sheet. Goodwill is how much here? 137 that here. Okay. They have prepared a note stock on it. No. Okay. Wait. 137 that here now. How it is 192 is coming. Just give me a minute that here now. Okay, 137 is there. Okay, now understand this one. 137 that is which is the difference, and I have my own goodwill as well. Okay. How can I? Is it goodwill that here? No. Non-current asset that here now. Is there any? No. Oh, okay. Yes. In general entries, this is one more here. 137 and this. 55 is also there, na? So 137 plus 55. That is coming 192. So here 192. Correct? Okay. Then anything left in entries that here now we have tick. All should be tick. Okay. Short-term borrowing also we have, I think, recorded. Recorded? No one. Yes. Short-term borrowing is how much here? That is coming. Short-term borrowing. Okay. 1975. My mistake. I missed that. Okay. Short-term borrowing 195. Nothing should be missed here. Tick. This is also tick. Securities premium. Okay, 1,500. So write down reserve and surplus 1,500 there. Okay. Then here the next entry tick. All are tick that here. Okay. Note stock on first completed that here now. Yes. Second is reserve and surplus 21,000. Write down here 21,000. Third long term borrowing 25755 here. So write it down. I am 25755 here. Then I have here is trade payable. I have already what? Okay. Yes, tradable 20,375. Done. Balance sheet will get tally. So what are the steps that you have to solve it? First, we have to find it out what? PC. Always calculate a purchase consideration. Then journal entry if they ask you. Third, balance sheet. Okay. What are the steps in balance sheet that here now? First, remember that here now. Asset debit should be add. Okay. Or you can say that here now. Asset has debit balance that here. Okay. Or you can see that asset has a asset. You can write it on like expense has debit balance that they have what? Debit balance. So if in journal entry, if you're debiting them here, we have to add them. If you're crediting them, you have to deduct them. Now liability, income and and capital has credit balance. So in entry, if you're crediting them, add them. If you are debiting them here, deduct them. This is the basic rule that here. Follow these rules, the balance sheet will get tally. Simple that here. You need a practice. You need a practice of these chapter. Okay. Otherwise, it is very, very simple. That you just need the practice of that here. Okay. You need a practice. Okay. Now, just one more thing is that here about the PP is that how can I miss the PP? Okay, PP I have written directly there. Okay, it is on 206. Okay, no problem. Okay, I have written it directly. Okay, if you have done the calculation, we write it on there directly. Okay, okay, done. Okay, so that we have solved the question number here, the question number 27, I think now. Okay, now what we'll do that here now. Here in question number 28 is also interesting that here. In our discussion, understand still where it is important. Long marathon it will be. It will take so much of time that here we have to take one by one. We have to understand properly. So what we have discussed till now that now we have discussed the accounting in the books of purchasing company. Okay, accounting in the books of purchasing company that now and purchase method. So we have discussed this 5 entry now. This 2 entry will also come. I will explain you that here. So what before we go to in the books of vendor company or amalgamation nature of merger. We will solve a question number 28 as well. Okay, now question number 28. P and Q. Okay, question number 28. P and Q have been carrying on same business independently. Due to competition in the market, they decided to amalgamate and form a new company called PQ Limited. So what happened here? It is a case of amalgamation. P Limited and Q Limited, and they are forming a new company, PQ Limited. That here. Okay. Now the balance sheet is the following is the balance sheet of P Limited and Q as at 31st of March 2007. Okay. Now capital is 7,75,000. These type of question are so many times asked by ICI. Okay. Now capital 7,75,000. Here 8,55,000. Current liability 6,23,500. 5,57,600. Asset here plant and machinery 4,85,000. 6,14,000. Building 7,50,000, 6,40,000. Current asset 1,63,500, 1,58,600. Now, following are the additional information. The authorized capital of the new company will be rupees 25 lakh divided into 1 lakh equity shares of rupees 25 each. So, how much is the authorized capital? Authorized capital is given. So, we'll write it down in notes to account number 1. That is 1 lakh equity shares of rupees 25 each. Liabilities of P Limited, P include rupees 50,000 due to Q for the purchase. Q made a profit of 25% on sale to P. Okay, now understand this point here. Here what happened now? P includes that here liability of P. So P is liable to pay to the Q. So what? P is liable to pay to the Q that here now. Now they come together and form a new company. So we have to cancel this intercompany dues there. Okay. Now P is liable to pay Q and P is for Q it was receivable that year. Okay, but something that I will discuss with you, new concept in this question. Q made a profit of 20% on sale to P, that I will discuss with you. Okay, now they say P has goods purchased from Q cost to him rupees 10,000. This is included in the current asset of P as on 31st March 2007. So there is some connection between these highlighted point here in point number 3. So I will discuss this point 2 and 3 in detail with you. Now they say the asset of P and Q are to be revalued as under plant and machinery P 5,25,000, Q 6,75,000. Building gear 7,75,000, 6,48,000. The purchase consideration is to be discharged as under. Now understand this one. They are talking about here the purchase consideration, how to discharge them, how to pay them. So first they say that now issue 24,000 equity shares of rupees 25 each, fully paid up in the proportion of their profitability in the preceding 2 years. Now, very interesting. They mention that here now we have to give them 24,000 equity shares. Okay, now who is the purchasing company? PQ. Now P Limited, Q Limited, these are two vendors company, and PQ Limited is a new company. Okay, it's a purchasing company, and these two are vendor company. Now they say that here now 24,000 equity shares is going to be issued by purchasing company. How many shares it is going to be issued by purchasing company? 24,000 equity shares is going to be issued by the purchasing company in the proportion of their profitability in the preceding 2 years. So they are telling us that here now, whatever they have in the preceding 2 years, profit is also given. Profit for the preceding 2 years is given PQ of 2 years. So they are saying that the purchasing company is going to issue total 24,000 equity share in the proportion of the profit of preceding 2 years. So this is the profit that they have in the preceding 2 years. So these 24,000 will be issued to 24,000 will be issued between P and Q in the proportion of these 475 is to 525. You got a point here? Okay. Now, so this is first, it is related to PC. We are giving the equity shares to the shareholders that year. Okay. Now this point, issue 12% preference shares of rupees 10 each, fully paid up at par to provide income equivalent to 8% return on capital employed in the business as on 31st March 2007 after revaluation of asset of P and Q respectively. Okay, now understand this point one by one. So these 2 points are connected to each other, A and B. Okay, and these and okay, but this point number 5 is completely on purchase consideration. Okay, I will explain you one by one. First, they ask us that here now compute the amount of equity and preferential issued to P and Q. So here we are giving equity shares, we are giving to the equity share. Here what we are giving, here we are giving the preference shares. In first case we are giving the equity shares, second case we are giving the preference shares. So how much equity shares they are giving there? Okay, now understand this. How much equity shares they are giving. So here they are giving 24,000, but in the proportion of what their profitability. I have to find it out the profitability, but it is so simple. It is given in the question that here. Okay. So 24,000 will be issued in the proportion of their profitability, and profitability of the last 2 years is given that. Okay, point number. I will come to this point also. Okay. Now you can see that here now when we talk about the profitability. Okay, PC calculation. First we are giving them the equity shares here. How many equity shares we are giving? 24,000 in the proportion of their profitability. Their profit is 4.75 and 5.25. So you can see that here now. Or you can see that in first case, this is first P and this is for the Q and this is total also given. Okay, so how they have calculated this? I can say that a 24,000, if I say 4.75 plus 5.25 is to 10. If it is 10, then how much is here? 4.75. 4.75. Here I can say that now, if 24,000 is 10, how much here is 5.25. So 24,000 divided by 10 multiplied by 4.75, that is coming 11,400 shares we are giving to P, and here it is coming 12,600. Total is come 24,000. Simple, very simple it is. Okay. Now understand this second point. What it says that in second point that now here they are saying that now issue 12% preference shares. Okay, we are issuing 12% preference share of rupees 10 is fully paid up at par to provide income equivalent to 8% capital employed. In the business that year as on 31st March 2007 after revaluation of asset of P and Q. Now understand this one. They say here we have to issue them 12% preference share, but they have to get the preference share will get the same income. Their income will be equivalent, the same amount of income they will get. What does it mean that here now? We are issuing the 12% preferential. It means that in future they will get 12% dividend. Simple to the preferential. We are issuing 12% preferential. So in future they will get 12% dividend that. Okay. But they said that 12% should be equal to 8% of their capital employed. So it means that here now 8% of their capital employed, whatever amount is coming that here now, that should be equal to, okay, that should be equal to, sorry, 8%, yes, that should be equal to 12% here of this preference share that here. So it should be equal. So what is going to happen now here? We know, or you can write it like that. You can write it like that, okay? Okay, this one. So 8% here of preference shares, 8% of capital employed should be equal to 12% of the preference shares capital is there. Okay. Now, because they want the same amount of return. So whatever the 8% capital employed, that much dividend they should get in the future. Now understand how we can decide. Very simple is that. Okay. So first for this, I need a capital employed. What is capital employed? Asset minus liabilities capital employed. Now, but they say this capital employed when they are calculated that here is after revaluation of what here? Asset here. After revaluation of what here? Asset here. Now understand this one. When I say that after revaluation of asset, so they have revalued the asset here. So these figure we have to take for the asset. Other will be the normal, whatever the figure is given. Now let's take one by one. If I say property, plant and equipment, that is it, the new figure is given there. Okay, here, how much it is that here? is 5,25,000 and 6,75,000. So 5,25,000, 6,75,000. Okay. Now building 7,75,000, 6,48,000, 7,75,000, 6,48,000. Then here the current asset is okay. No revaluation current asset. We have to take as it is. 163,500, 158,600. 163,500, 158,600. The total assets here. Okay. Now liability will deduct it here. How much is the liability here? Current liability only 6,23,500, 557,600. So 6,23,500, 557,600. This is capital employed. So they are saying us here, whatever is the 8% of capital employed, they should get that much of dividend, and dividend rate of dividend is 12%. Okay, no problem. So what I will say that here now, can I say that how I'm calculating here? Understand this. Can I say that here now? 8,40,000. Understand the logic. Very simple is that. Okay. 8% of it that here. Okay. That is the 8% of it. That should be here. Is whatever amount is coming that here. Okay. Now, if I say that here, that is coming here 8,40,000 multiply by 8%. That is coming 67,200. This much amount of income they should get. Okay. So now they are getting 12% preferential. So they will get 12% dividend. If this is 12, then how much is 100? So 67,200 divided by 12 multiplied by 100. That is coming how much here? 5,60,000. So they are going to issue this. You can see that here now, please. 5,60,000, 5,60,000. Let me tell you what happened here. If you take that here now, 8% of capital employed. So I will take 8,40,000 multiply by 8%. That is coming 67,200. Okay. And if you see, okay, or it should be equal to 12% of we have issued 5,60,000. Okay. Now cross check it that here. 8% of 8,40,000 is equivalent to 12% of 5,60,000. But we have to find 5,60,000. So we can say that here, that 8,40,000 is 8%, 67,200. And this much amount of dividend they should get in a new company. And what is the rate of dividend? The rate of dividend is what here? The 12%. They should get this 5,60,000, 5,60,000 like that. Here you can calculate. Can I say that here now? In second case that I will say that here 9,24,000. 9,24,000. If it is that here now, okay, no. 9,24,000 is a capital employed. Okay. So 8% of capital employed, that is coming here 9,24,000 multiplied by 8%. That is coming 73,920 divided by 10 multiplied by 100, because this much of dividend they should get in the rate of dividend 12% divided by 12%. That is coming 6,16,000. So you can see that here now 6,16,000 here now. Okay. Now done. This is how we find it out that here. Okay. Very interesting. Now, this much amount of equity shares we are giving them, they have multiplied. This is the number of shares. Okay. And we are issuing shares at the rate 25 is the face value on. So multiply by 25. This is the amount of equity share capital we are giving, total capital equity share, and this is the amount of preferential capital we are giving. And this is the total amount of purchase consideration. Okay. Done. Once we have done this part, then in every question, the challenge is here that to calculate the amount of PC. Now, very interesting point I'm telling you that here now. What they ask us that here now, we have find it out that here now, how much is the equity shares and the preference share we should give them. Okay. Now, what we have to do is prepare the balance sheet that here now, immediately after the amalgamation. Now, very interesting point I'm saying. In previous question was the case of absorption. Now, understand the difference. What happened in absorption and amalgamation? What is the difference here? Now you do understand this one. In case of absorption, okay, in case of absorption and in case of amalgamation, now understand the difference here. What happened that here? In previous question, when we solve that here, what's the name that here? Whatever name that here, nice and well. Okay, whatever name. Let's say that here now, P and Q only. Okay, P and Q only. So suppose the Q acquired to P. So it's an existing company. So when we prepare a balance sheet, please understand, when we prepare a balance sheet, if it is an existing company, already their balance sheet existed, and we have to take into effect all the entries that we have passed and whatever amounts that we have done in the previous question, that we write it down in a new balance sheet. But in case of this existing company here, okay, this existing company. But what happened here, P and Q that here now. Here two companies come together and they form a new company, and what they call them PQ Limited that here, and it's a new company. You know what is the difference here? In case of a new company that here now, there is no existing balance sheet because it's a new company. They don't have any balance sheet here. You got the point here? But in the case of a new, but if it is an existing company, they have their own balance sheet, okay? And whatever transaction we have done during the time of this absorption, that we have to take into consideration, and then we prepare a new balance sheet. But here they don't have any new companies. They don't have any existing balance sheet that here. So how to prepare the balance sheet? Very simple that here, okay? We are going to take effect. We have taken these all assets and liability by the purchase. Oh, okay. One good thing is that now what happened that if they ask you to prepare a balance, to pass a general entry and then prepare a balance sheet, then that will be so easy for you. The reason is that here now, because they ask you that, because if they ask you to prepare to pass the journal entry, so what we have to take? We have to take the amount, the entries that we have passed, and just have put in the balance sheet. So balance sheet will get tallied. But the problem is that they don't ask you to pass the journal entries. Please listen to me carefully. They don't ask you to pass the journal entry. They ask you to prepare what? Directly the balance sheet. So we have a problem that here now, because we have to directly prepare what here now? The balance sheet. So how we can prepare the balance sheet here? Okay. So it is simple. Don't worry for that here. I will explain. PC we have calculated these points. I will take. But what is the second and third point? I will explain it. Don't worry for that. But what happened that here now? Already the figures are given here because we have calculated this capital employed. We know that these assets we are taking by the purchasing company, plant and machinery, building, current asset, these liability. Just we have to take the figures from here and we are giving them what here? These equity shares and this much of preference share that here. We will write it down in balance sheet. That's it. Simple. Okay, I agree with you that here. We just have to take it down the figure from there. Okay. But there is one problem that I will discuss with you that here. First, let's write it down one by one. So when we prepare a balance, there's so many things. You know that just you have to listen me. Each and every word is important. Just listen me. Because I'm going to tell you so many important things that here. 100% that is going to help you in examination that here. Okay, 100%. Because so many important points. How to decide the working note, which working note should we prepare and all that. I will explain you that here. Okay. Now here is that here. Let's take one by one. Okay, let me change the colors. It will be easy for us that. Okay. So here we have here is the how much we have here. The plant and machinery we have here is 5,25,000, 6,75,000. So plant and machinery, if I do the total here, 5,25,000, 5,25,000 plus 6,75,000. That is coming how much here? Is 12 lakh. Now here 7,75,000 plus 6,48,000. That is coming 14,23,000. Okay. Now is current asset 1,63,500 plus 1,58,600. This is one adjustment is of the intercompanies. I will come to that. But that is coming 3,22,100 like that. Okay. So 3,22,100. Okay. Now then we have here this current liability here. 6,23,500 plus 5,57,600, 11,81,100, 11,81,100. Okay, done. Now we have written in all those. Now we have issued the equity share capital. How much? 2,85,000 and 3,15,000, total 6 lakh. Basically 24,000 equity shares of rupees 25 each. So you can see that notes to account number 1. Okay, they have not prepared. Okay, that here. But if you notes to account number 1. Okay, notes to account number 1, that is authorized capital we have here. We can write it down that 20 with this 1 lakh equity share of rupees 25 each, then 24,000 multiplied by 25. That is coming 2,85,000 and 6 lakh. So that is no 2,25,000 and 3,15,000. That is coming how much is 6 lakh that here. So here you can see that here now the 6 lakhs is the equity share capital. Okay. Now preference how much we have here now? 5,60,000 and 6,60,000. That is coming 11,76,000. So preference share capital 1176. This is the total amount of capital. Okay, almost done. Now understand this point here. Now, what happened that here now? There is the one the problem that you will say. What is the problem? So that always remember. I will come to these 2 points. Okay, don't worry for these 2 points. I will come and discuss with you. Don't worry for that. But what happened that now? Very interesting for what I'm saying to that here now. In examination that here, if they ask you to prepare profit, if they ask you to pass journal entries that here, then your task is simple that here. The reason is that, because do you remember the previous question that we passed the second entry that here, where we find it a difference. If debit is getting short, we write it down in goodwill that here. If credit is getting short, we write it down here in what? The capital reserve. So try to understand that if debit is getting short, we call them goodwill, and if credit is getting short, we write it down in what? The capital reserve that here now. But what is going to happen that here now, when I say that here now, so but we are not passing any journal entry here. So if we are not passing any journal entries that here now, what does it mean that here? I don't know how much is the difference that here. Correct? I don't know how much is the difference that here now. Now understand this one. It means we have to prepare a working note in examination. So always remember that here. To find it out whether there is a difference in second entry, goodwill or capital reserve, I don't know that here. If they ask you entry, that will automatically come as a balancing figure. If they don't ask you journal entry, then we have to make a working note. Okay. Now what happened that here now? We have to make a working note. Now what happened that here now? How much is the goodwill that, how we calculate? Let me tell you that now. Now P, Q. Okay. Here, how much is the business, PC due that is, how much is the amount of PC that here now? Or how much is the net asset that you are taking? You can see that here now, 8,40,000. So net asset I am taking here, 8,40,000. Okay. And for Q that here now, how much I am taking? 9,24,000. How much I am taking? 9,24,000. Okay. Oh, this is net. Is it not okay? Visible or no? Okay, no problem. So here, okay. Now here, how much is the amount of PC? You calculate here, 8,45,000. So I will write it down, 8,45,000. And here I have 9,31,000. So I will write it down here, 9,31,000. Now understand this point here. Here, net asset that we are taking, that is 8,40,000. But we are paying them how much? 8,45,000. We are paying 5,000 more. So this is goodwill, 5,000. Okay. Here the net asset we are taking over Q 9,24,000. We are paying them 9,32,000. The difference is coming how much here? 931. Sorry, 931. So here is 9,24,000. We are taking the net asset and we are giving 9,31 is a pay. So 7,000 goodwill. The total amount of goodwill 5 plus 7, that is going to come how much here? 12,000 here. So total amount of goodwill which is coming here, how much here is the 12,000 here. Okay. If we don't find it out that here, your balance sheet will not get tally that here. Okay. So when we pass entry, it automatically come as a balancing figure. Okay. The 12,000 is the amount of goodwill. Okay. So let me write it down that here now is the inner column I'm writing. I tell you why 12,000. You'll say no sir. Here the 14,000 is mentioned. I will come to that. Don't worry. Okay. Now you find it out as the goodwill. How much is the goodwill? Is a 12,000. Okay. Now come to these 2 points. Right. First they say liabilities of P include rupees 50,000 due to Q for the purchase made that. So the P purchase from the Q, P is liable to pay to the Q 50,000. Mutual debt that. So that we have to cancel. So what we do that here, we are going to deduct 50,000 from debtors, 50,000 from creditors. So I will go to this current liability. They have not mentioned debtors and creditors. So they have said current asset, current liability. No problem. So I will deduct 50,000 from, you can see that here now, from creditor and 50,000 from debtors that here. Okay, current asset. Now here they say, when Q sold to P, he made a profit of 20%. Okay. What is the problem? I tell you what's the problem here. Now P has, no second point. P has goods purchased from Q, cost to him is 10,000 that is. This is including the current asset of P as on 31st March 2007. Now very interesting point. Now please understand this part here. Now suppose let's become, I am P and you are Q. Okay. I purchase something from you and I am liable. Listen very carefully. I am P and you are Q. I purchase something from you and I am liable to pay you 50,000. Okay. Now we become a one company. Okay. PQ Limited. So in my liability side, it will appear as the 50,000 and on your asset, it will appear as the 50,000. So now we become one company. So we have to eliminate it. So that's why we deducted 50 from current asset, 50 from current liability. Okay. 50,000 from current asset and 50,000 from current liability. Okay. Now what is going to happen here that now I am coming to the next. What happened that now? Okay. We deduct 50-50. But what happened? Who made the profit here? You made the profit here. Okay. You made the profit here. Okay. Because you sold to me, you are Q, I am P. So how much profit you made? 25% on the sales. The sales is 50,000. Okay, and 20%. But what is the main point that here? How much still in the stock that here? I purchase something from you. Suppose 50,000, I am liable to pay 50. That's a different thing. That is, I was discussing about that account payable and receivable. Now I'm discussing with you with stock. So out of 50,000, only 10,000 is in stock. Only 10,000 in stock. So don't tell me sir, mutual debt should be cancelled by 10. No. That is payable and receivable still is the 50,000 only. Out of that 50, the 10,000 is in the stock that here. Okay. So my 10,000 is in stock that here. Okay. So what is the problem that here? The problem is that here now when you sold to me that here. Okay. When you sold to me that here, the problem, I'm coming to this point, okay, seventh entry that here. The problem is that here now when you sold to me that here. Okay. So you made a profit, correct? You made a profit. Okay. So what happened that here? What is the problem that? But I purchased from you. Okay. You made a profit. And out of 50, only 10 is in stock. That out of 50, only 10 is in stock. So on asset side, that is the stock which is appearing that here now, which is overvalued. Why? Because there is 20% profit component on it. That is. So you will tell me, sir, but you have purchased 50,000 now. In the remaining 40 also there is the profit component. I agree with you. But those 50,000 is not in stock. I have already sold to the third party. If I already sold those 40,000 to third party, which is already realized, no need to do the adjustment. Profit is we have collected from the outside. No problem. But out of 50,000 that I have purchased from you, the 10 is in stock. Remaining 40, I don't care because we have already sold to the outsider. So we already made a profit, recover the profit from the outsider. That is realized profit. But the 10,000 which is in stock that year is a profit component in that year. And when now we become a one company only. So when we become a one company, it means that here we sell to ourselves and we made a profit. It is like which is in the stock only. If we have forwarded the profit to outside or recover the profit from the outside, then it's okay, no problem. But out of 50, 10 is still in the stock that here now. If that is in the stock, so what we have to do that now? The profit component should be eliminated. So they say it is also mentioned in rapid gist in point number 10 that here. Okay. What mentioned in rapid gist in the point number 10 that now here in the third point that here. They say now here during a takeover, it's possible that now the vendor company holds stock purchase on the purchasing company at the selling price, including the purchase company's profit, the purchasing company takes. So same. Whoever said the intercompany happen, purchase company to vendor company, vendor to the purchasing company, whatever that here. Okay. So they say how to pass the entries given that here now, but in there also when I write it down the journal entries there, it is mentioned there as well that okay. The what says seventh entry. We call it unrealized profit. Intercompany stock which is in stock out of 50, 10 is in stock that here. So obviously I have to reduce the value of the stock. Stock is asset, asset has debit balance. I have to credit to stock. Okay, to decrease the asset. So here we decrease the asset to stock account. But which account should be debited? So they say first priority should be given. If in second entry we have goodwill, so debit to goodwill account. Okay. If we have in second entry capital reserve, debit to capital reserve. If they don't have goodwill and capital reserve both, so second priority we have to give to general reserve or P&L account. Profit should be reduced that here now. So when I go here that if I go to these entries that here now what happened here? We made a profit here. Okay. Listen now. P has goods purchased from Q. Cost to him rupees how much here? 10,000 that now. Cost to him is cost to P. It is a out of 50, the 10 is in stock. Cost to him means P. So to him it's a selling price only. Okay, it is cost to me, but you sold at that price, so which is cost to me only. Okay, so 10,000 multiplied by 20%, that is coming how much here? 2,000 here. In second entry, goodwill came, so goodwill account should be debited and stock account should be credited. Okay, it should be 20% profit. How? Why 20% profit that I have made? Okay, now here, so goodwill account should be debited. So that's why that here now this 2,000 they added here. Or let me write it down. The 12,000 was goodwill. Find it out. 2,000. This is how much is coming? 14. Okay. Now goodwill you can show separately here. Okay. And PP separately. Okay. Now goodwill account debited to stock. Reduce the value of stock. We reduce the value of stock by 2,000, and this amount is coming that here now. Okay. Now done. You understand? This is how we get 14 marks is there now. They ask these type of questions for 14 marks that here. Okay. But what is important that here now? Your understanding. Okay. Concept. Go to the root only. This is a marathon that here. Okay. Still I am trying to cover all the adjustments. Okay. So at the end of the marathon, you will observe that now all the adjustment, whatever adjustment given in the concept book, that all 100% adjustment we are going to discuss through the questions here. Okay. Now what happened that now? Now before I come to question number 29 that here now, I want to discuss. Do you remember that when we started this marathon, I told you that now we are discussing accounting in the books of purchasing company. Two possibilities in the nature of merger, in the nature of purchase. So just now we discussed the amalgamation nature of merger. If any of those 5 conditions now say purchase method. So we discuss the purchase method. We solve 2 questions on that. Now I will come to this merger method at the end that. Now I am moving to accounting in the books of vendor company. So what we are doing that now, how the vendor company, okay, how the vendor company is going to do the accounting in their books of account. Okay. Now we are discussing this, the vendor company's accounting. Okay. Now understand this here now. When we talk about this vendor company that here now, what is going to happen? How the vendor company that here now is going to pass the account. Purchasing company will discuss later. Okay. Point number that you have to come to point number 9 that here. Okay. 9. So listen very carefully. Very simple. Okay. Now accounting in the books of vendor company to close the books of account. Now what is important that here, whether that here accounting section 14 says anything that here about the accounting in the books of vendor company, the answer is no. They didn't say anything that here. Why? Because there's nothing special here. Because all the vendor company is going to close down. So when the vendor company is going to be liquidated that here, we just have to close down their books of account. So vendor company is going to liquidate that here now. When the vendor company is going to be liquidated, what we have to do that here? What we have to do that here now? We just have to there close the liquidate, I'm to close the books of account. Okay, so our agenda here in case of a vendor company when we do the accounting is to close down the books of account. You got the point? We just have to close down the books of account. Okay, now these are the steps I'm telling you that in the form of 11 entries that here. Okay, 11 or 12 entries will come there. Okay, now understand that now how we are going to close down the books of account. Understand these steps that here. Okay, now first that here now, imagine a balance sheet. What I'm saying that here now, imagine a balance sheet of vendor company. Now we all are for the next 15 minutes that we all are a vendor company and we are trying to close the books of account of vendor company. So what is our agenda that here now? To close down the books of account of vendor company. You got the point here now? So when we close down the books of account of vendor company that here now, how we are going to close it down that here now? Okay, if I say that here now, okay, this is my here is the balance sheet here. Okay, this is the balance sheet here. Okay, now this is my balance sheet here now. Understand this point. This is my balance sheet here. Okay, now what happened that here now when we talk about the balance sheet here, equity here. Okay, and here they have a that reserve and surplus also. They have a liability and here they have an asset. Okay, let's take one by one. Now we are going to close down the books of account of vendor company. Okay, now first that here now. Here it is not the case that here that we are selling the asset individually. We are closing on the company that here. We are liquidating the company that here. We are not selling the asset individually in the market. So what I will do that is to make it simple for you. It might be happen all the asset and liability is going to take over by the purchasing company, or it might be happen some of the asset. Each and every word is important. Listen very carefully. It might be happen all asset and liability will take over by the purchasing company, or it might be happen some of the asset and liability will be taken over by the purchasing company. Okay, whatever the case that is, if all the asset and liability is going to take over by the purchasing company, perfect. If some of them is going to take over by, it means the remaining we have to sold it in the market or pay the liability because that is not taken over by the, suppose I have 10 assets, out of the 10 purchasing company take over only 8. So what about the 2 assets, remaining 2? That remaining 2 is going to be take over, is remaining 2 is that here, what is going to happen in case of a remaining 2 that here is going to be that here now take over by the, is remaining 2 is we have to do the settlement. If liability have 4 liability taken over by the purchasing company. For the remaining one, we have to do the settlement. Okay, whatever is the case, I will come to that now. So first, ultimately, we are closing the books of account. Okay. So first, what I will do that here now, I will write it, I will transfer all my assets to a account, and we have to close the books of account to account and to a box. And to this box, I call a realization account. Because I don't have time. It's a marathon. I cannot, I'm going to send detail. I cannot take so much of time. But let me try to convey the message here. If that here now, if I say that here now, is I'm going to say we are not selling individually assets here. When I say I'm not selling assets individually here, that here. So what does it mean that here now? It means that here now is that we have to close down the books of account. So we have to see the net effect, transfer all the assets, all the liabilities, and what price taken by the purchasing company, and see the difference. Whatever profit come, we'll give to the owner that year. But we are not selling individually that. So first, even though it is taken over by purchasing company, you are not transfer all the asset that year. So asset has which balance? Asset has debit balance. Simple logic. Remember the asset has debit balance, liability has credit balance. So asset has debit balance. We want to close it down, so we have to credit them here. So what I will do that here, I will pass the entry. I will credit to a asset account. What I will do that is I will credit to asset account that now. And what we'll do that is we'll debit to a realization account. So what is going to happen? We are going to pass the entry here. realization account will be debited here, and asset account will be credited here. So we are going to pass the entry here. Realization account will be debited here and asset account will be credited here, that here now. Okay, now please, why? Because asset has a debit balance that here. So when I say that your asset has a debit balance, if you want to close it down the asset account, we have to credit them here. Okay, so asset account will be credited and realization account will be debited. So here in these box, it's the realization account. We transfer all the asset balance to realization account. Okay, I will tell you what is the logic behind it. We'll go to sequence. Okay, now they say all assets here transfer to realization account except cash and bank unless taken over by the purchasing company. Why cash and bank balance we don't transfer generally? Because the settlement we don't transfer it, because if cash and bank is, I mean to say, if not taken over by the purchasing company, but still it might be happen, we have to do the receive some amount from someone, we have to do the certain settlement, so it might be happen. So we keep it separately only cash account, and we make a separate account cash account, and at the end we do the settlement there. Okay, whatever balance left we give it to the owners that year. So they say all asset must be transferred to realization account except cash and bank bill unless taken over by the purchasing company. If it is taken over by the purchasing company, so with no receipt and payment, it is taken over by the purchasing company, just give it to the transfer to the realization account. So we transfer assets balance to realization. So I will go to balance sheet. These assets will be transferred to realization account by passing the entry realization account debit to asset account. Now I will go on liability side that here now. I will transfer liability. Understand the logic. I will transfer liability here now. What balance liability has? Credit balance. So liability has credit balance. When I will transfer, we have to debit them. So entry will be liabilities account will be debited and realization account will be credited. So what I said that here, liability account will be debited and realization account will be credited because liability has credit balance. If you want to cancel them, we have to debit them. So I am to pass entry here. Liabilities account will be debited and realization account will be credited here. Okay. Now, after this third entry, I am coming to now this equity part, this equity part. Okay. So equity share capital is credit balance. That amount I am liable to equity shareholder. So first we'll cancel equity share capital. Capital is a credit balance. So I will pass entry equity share capital account will be debited here. Okay. I am liable to pay to the equity shareholder. So equity shareholder account will be credited. If I have reserve and surplus, this reserve and surplus is the undistributed profit basically. And this undistributed profit we are liable to pay to the shareholder that here. Okay, equity shareholder. This undistributed profit we are liable to pay to the equity shareholders that here. Okay, so we'll cancel this reserve and surplus. Reserve and surplus has credit balance. So reserve and surplus account will be debited and equity shareholder account will be credited here. Okay, now what happens that certain time it might be happen, we have certain losses or undistributed or you can say the miscellaneous expense that which we have not yet write it out. So we have to cancel them as well. If this profit we are giving to the shareholder, those loss or expenses should also be bear by the equity shareholder. Okay. So loss is a debit balance. If you want to cancel it, we have to credit them. So you can see that here, profit and loss account, miscellaneous expense, discount on issue of debit, or if it is not yet write off, so this also has to be bear by the equity shareholder only. These losses and expenses are debit balance. If we want to cancel it, we have to credit them. So I will credit these losses or miscellaneous expenses and I will debit to equity shareholder account. So what we have done here now in our balance sheet that here we transfer asset to realization, liabilities to realization, equity share capital, reserve and surplus to equity shareholder account. Similarly, if loss that we have, that also has to be bear by the equity shareholder only. Now what happened that here? Now I am coming to a part and we call them the preference share capital. What is this preference share capital? Now please understand this point here. What is this preference share that here now? It might be happen that I don't just equity, we might have preference share also. So we are liable to pay to preference shareholder. Like that we transfer the equity share capital to equity shareholder account. Similarly, we are to transfer the preference share capital to preference shareholder account. So if we have a balance of preference share capital, we are going to cancel them. Preference share capital has credit balance. If you want to cancel them, we have to debit them. So we are going to pass entry. A preference share capital account will be debited and preference shareholder account will be credited here. So here you can see that now preference share capital account will be debited and preference shareholder account will be debited. Credited. Now you will ask me that preference share capital debited, preference shareholder account credited. Now you can ask me, sir, what is this realization account? That I will tell you later. It is pending. I will tell you later. Okay, one of the question I think it will come. I will explain it there. Okay. Now, so what we have done, we have transferred all the asset, liabilities, preference share capital, equity share capital, reserve and surplus to relevant place. So these four entries: first asset, liability, preference share capital, reserve and surplus, and then the preference share capital. Okay, equity share capital and then preference share capital. Now remember that a PC due. Now we are not selling individually asset. We are not doing the settlement individually of all the liabilities there. The amount that asset and liability we are going to transfer to the purchasing company. Now we are going to recover the amount from them here. So we call them PC due. We are talking from the vendor's point of view, the selling company's point of view. So when I say that from the vendor's company point of view, the amount is recoverable. So what is going to happen that here now? What is going to happen here now that here now is if they are going to pass, the purchasing company account will be purchasing company account will be debited here and realization account will be the credited here. Why realization account? Think from the vendor's company point of view. This is the amount which is recoverable from the purchasing company. This is the amount which is recoverable from the purchasing company. So we all are vendor company now. So recoverable from the purchasing company. So increase in assets, the purchasing company account debit. And we are going to transfer to realization account because it's a income. I mean, we are going to recoverable. So all asset liability we have transferred to realization account. This realization account that here now. The amount which is recoverable for this asset and liability will also be transferred to realization account. Difference whatever comes, that will be either profit or loss. Simple. So recoverable from the purchasing company, so purchasing company account debit to realization account. But remember that now. It might be happen that now some asset not taken over by the purchasing company, some liability not taken over by the purchasing company. If they have not taken some asset or liability that here, we have to do the settlement here. But how to do what entry do we pass when we pass the entry of sales? We pass the entry cash account debit asset, not sales goods. I'm saying sale asset that is. So we pass the entry cash or bank account debit to asset account. But here I cannot do 6 point. They say asset which is not taken over by the purchasing company. I cannot tell that here if the asset which is not taken over by the purchasing company that here. I cannot say that here now if the asset which is not taken over by the purchasing company. Okay, but it means we are doing the settlement that here. We are going to recover from that particular asset. So I cannot say that cash account debit to asset account. You will say why? Because we have already closed down the asset account in entry number 1. We have already transferred all the asset to a realization account. So when I say that we have already transferred all the asset to the realization account, what does it mean that here now? It means if you have transferred all the asset to the realization account that here, what does it mean that here now? Already asset account get closed that here. When I'm selling them, I cannot say that here cash account debit to asset account. So it is not correct. The reason is that asset account already closed in first entry because we have transferred all the asset to realization account. Okay. So here we are going to pass into cash account debit to realization because we have to recover the cash when we sell the asset individually that is. Okay. Similarly, when we talk about the liability, is a liability not taken over by the purchasing company. So what is going to happen? Generally, we pass on payment of liability, we pass entry liability account debit to cash account. But I cannot say liability account should be debited here because liability account already get closed in entry number 2. We have transferred all the liability to realization. So there is no liability account. So if even though it is not taken over by the purchasing company, we have already transferred to realization account. So what we'll do that, we will do the settlement here now. When we'll pay them here now, we have to pass the entry that here now. Realization account debit to cash account. We cannot say that here liability to cash because liability account already get closed that here. We are talking in entry number 6 and 7 only for those assets and liability which is not taken over by the purchasing company that here. Okay. So remember the sequence, 12 entries that here. First, asset transfer, liabilities transfer. Third, equity share capital, reserve and surplus. Fourth, preference share capital. Fifth, PC due. If 6 is asset not taken over by purchasing company and the liabilities which is not taken over by the purchasing company. Okay. Now 8th one. If expense of winding up paid by vendor company, the purchasing company pays, so they debit to goodwill account, capital reserve account. But if it is paid by us, by the vendor company, you all are vendor company for next 5 minutes also. So we are going to pass, it is an expense. So cash, the realization account will be debited and cash or bank account will be credited because we are paying that here now. Now what happened now here? This is my realization account. So we transfer all the assets, all the liabilities, whatever the PC we transfer there, any settlement that we have transferred there. All expenses also liquidation. If it's credit balance is coming that way, if credit balance is coming in this realization account that is, that's the profit that is. If the profit is coming that here now, what is going to happen that is that profit will give to the owner. Who is the owner of the company? Equity shareholder. So here we are debiting to it's a realization account that is. We are debiting to realization account that here now. So we have to pass the entry here now. Realization account will be debited here and equity shareholder account will be credited here. If we have a loss here, now, so we are crediting to realization account. Okay. So we're going to bear this loss, equity shareholder, because they are the owner. So equity shareholder account will be debited and realization account will be credited here. Simple that. Okay. Now till 9th. Okay, not 10 that is. Now PC due. PC was due that na. We pass the entry. Something is recoverable from the purchasing company. We pass the entry. Purchasing company account debit to realization. Now the purchasing company will give us what they will give us. They might give me the shares. They might give me debentures. They might give me cash or bank or any other. All those will be debited. And I don't care about the premium and all that. We have to recover and we have to give it to our shareholder that year. That issuing company, the purchasing company is going to credit to securities premium account. We don't do that because we are receiving that here. So shares, debenture, cash or bank or any other asset. Now who is the giver here? Purchasing company. So we're going to pass entry, shares, debenture or cash or bank we receive, and who is the giver? Purchasing company, and purchasing company account will get closed. Now we receive this share, debenture or cash. We'll give it to the relevant person. If you are giving to equity shareholder account will be debited, preference shareholder account will be debited, and we'll credit those shares in purchasing company, debenture or cash. So whatever shares, debenture, cash that we have received, so whatever amount is payable to the equity shareholder will pay to them. Whatever amount is payable to the preference shareholder will pay to them that year now. Okay. Now what happened now? Whatever balance that we have here in whatever balance that we at the end, if we have a cash account is not taken over by the purchasing company, whatever balance that we have in cash account that will be given to the equity shareholder because they are the ultimate owner that year. Okay. By following, you can see the 12th entry. Okay, equity shareholder account, debit to cash or bank account. By passing these 12 entry, the books of account of the purchasing of the vendor company will get closed there. Okay, with all account of vendor company will get closed there. So remember these 12 steps there. First, transfer all assets to realization account, then liabilities, then equity share capital reserve and surplus transfer to equity shareholder account, preference share capital transfer to preference shareholder account. Okay. Fifth, PC due. Sixth, asset not taken over by purchasing company, liability not taken over by the purchasing company. Then here the liquidation expenses we have to pay. If paid by, they pass the entry, profit or loss on realization, transfer to equity shareholder. Then 10th is the receipt of the PC from the purchasing company. 11th one is the giving those whatever we have received from the purchasing company to the equity shareholder, preference shareholder that now. And 12th is the distribution of profit to the equity shareholder. Sorry, cash, whatever left in there. If you follow these 12 steps, all the books of account of the vendor company will get, all the accounts of the vendor company will get closed. Okay. So this is all about the discussion how to close down the books of account in the books of what? Vendor company. Now what we'll do that here now, we'll solve the question that here now, and remember that now. Okay, so to follow those 12 steps that here now, books of account will automatically get closed that here of vendor company. Now come to question number 29. And this is ICA favorite question. So many times they ask this type of question. Okay. X Limited was wound up on 31st March 2004 and its balance sheet is on that. They have given us the balance sheet. Now what happened that now here you can see that your share capital here is the share capital. Okay, wait. What is this 9? Okay, just cut it down this 9,64,000 from there. Okay, just cut down there. Okay. Now 1,20,000 equity shares offered with 10 each 12 lakh reserve and surplus profit prior to incorporation 42, contingency reserve 2,70,000, profit and loss account 2,52,000, current liability bills payable 40,000, sundry creditors 2,26,000, provision for income tax 2,20,000. Asset side, property plant and equipment 9,64,000. Then current asset here. Current asset stock 7,75,000. Sundry debtors 1,60,000. Less provision for bad debt that is 80. So 160 minus, sorry, not 88. 1,60,000 minus 8,000. 1,52,000. Bills receivable 30 and cash at bank 3,29,000. Total is 12,86,000. Okay. Now this is a balance sheet. Now this is Y Limited took over the following asset at value shown as under that. Now Y Limited. Okay. Now we'll take over the now Y Limited took over means it's a purchasing company. Okay. Now they are taking the very interesting point. They are taking here only what here. They say Y Limited took over the following assets only. Are they taking liability? No, they are not taking liability on only. They are taking few assets only. So PP they are taking at 12,80,000, stock 7,70,000, bills receivables. Only these assets they are taking here. Okay, only these assets they are taking here. Okay, now purchase consideration was settled by Y Limited as under. So what we are paying that now, 5,10,000 of the consideration was satisfied by the allotment of fully paid 10% preference share of rupees 100 each, and the balance was settled by issuing equity shares of rupees 10 each at rupees 8 per share paid up. So here they are talking about the settlement of the PC, how they are discharging the PC, what they are giving to settle the PC. So very important is they are saying that now, understand this part, because we have to find it the amount of PC. So here we are not going to find it out the amount of PC by payment basis. We are going to find it out by net asset basis. I tell you why. Because the green color which I highlighted, you don't understand it. Okay. Now they say 5,10,000 here. Okay, look at this here. I highlighted by this green color. Okay, focus here. 5,10,000 we are paying to the by the allotment of fully paid preferential. So we are giving the preferential of rupees 5,10,000. Okay, so perfect. 5,10,000 you are giving the preferential of rupees 5,10,000 that here now, and each share is of rupees 100. Perfect that is okay. But they say and the balance we are giving the equity share of rupees 10 is rupees 8 paid up. What is 8 paid up? I will come to that. But what is balance here? The point that I've circled here. What is balance here that I don't know now? What is balance here? Because we pay 5,10,000 preferential. What they say balance we are paying equity. What do you mean by balance here? We don't know that here balance here. So how to decide the balance amount? So what we'll do that here? We will find it out the PC amount by net asset basis. We'll find it out the purchase consideration amount by net asset basis. Whatever amount comes that here, we'll give them 5,10,000 in the form of what? The preference shares that here now, and the balance will give them in the form of what here? The equity shares that here. So we are going to find it out the amount of PC by net asset basis that here. But what type of asset and liability is going to take over by the purchasing company? Only three assets: PP, stock, and the bills receivable. Remaining they are not taking. No problem. Then they say here now, is the sundry debtor realized rupees 1,50,000, bills payable settled rupees 38,000. Income tax authority fixed the taxation liability 2,22,000. Now creditors were finally settled with the cash remaining after meeting liquidation expenses amounting to rupees 8,000. You know what they're talking about is completed in the third category. Let me say this third part. Okay. Now what they're saying that here now, they are basically here telling, not, let me tell you, this is here, it will help us the yellow color to find the amount of PC, green color discharge of PC. These are the assets of liability not taken over by purchasing company. How we do the settlement of it? Because the purchasing company is not taken over by all the assets and liabilities. So we have to do the settlement. This information is mentioned. I will tell you that, what to do that. Now they tell us to do three things. First, you are required to calculate the number of equity share preferences to be allotted by Y Limited in discharge of the PC. So basically tell us to how we are to discharge the PC. If we find out the amount of PC, then out 5,10,000 will give in the form of preference and remaining in the form of equity. Then they ask us in this point to that prepare the realization account, cash or bank, equity shareholder account, and Y Limited account in the books of X. So basically to close down X is a vendor company, to close down the books of account of vendor company. But they don't ask us to pass journal entry. They ask us to prepare the accounts. No problem. Those 12 steps, just remember, we'll pass the entry, we'll do the posting there, and we'll close down the accounts there. Okay. And then they say pass journal entries in the books of Y Limited. Who is Y? Purchasing company. Who is X? Vendor company. Okay. What is this first? PC. Okay. Now, did they mention that how much equity share we have to issue? No. So we have to find it the amount of PC by net asset basis. So only three assets taken. PP is 12,80,000, stock is 7,70,000, bills receivable 3 lakh. So fixed asset 12,80,000, stock is 7,70,000, bills receivable is 30,000. This is the total amount of what purchase consideration. That is coming 20,80,000 that is now. Okay. Not to be paid as that here now. This 20 lakh, no liability not taking over by the purchasing company. Okay, so this is the asset. Only these three assets are taking over by the purchasing company at this price. Okay, now how we are discharging? 5,10,000 we are giving them in the form of what? Preferentials. The 5,10,000 preference, and this is a balancing figure. So how we find it? 20,80,000 whole amount we are liable to pay, and we are giving them 5,10,000 in the form of cash. The remaining balance in the form of equity. This is the total amount we're discharging. Now they ask us to find a number of shares that here. So how many preferentials we are giving? Very simple that now. Total amount we are giving them 5,10,000. The share of rupees 100 each. So it will come 5,100 preferential. How many equity shares? 15,70,000 the total amount we are giving in the form of equity divided by 8, not 10. And say, why sir 8? Why not 10? Understand this one. What they tell us that here now? They tell us that here now. The balance was settled by issuing the equity share of rupees 10 each at rupees 8 per share paid up. So 10 is the face value that is, but 8 is the paid up value that. Okay, so we are considering 8 as a paid up. Now understand the logic here. If suppose you are I am giving to you how much you are equal. I am giving to you something their worth is 15,70,000. So I am giving a worth of 15,70,000. Okay, but what happened that now the 8 is paid up. If I divide it by 10, the shares will come. that share is getting 1,57,000. So divide it by 8 because the paid up is 8 only. So you are getting, if you multiply, you are getting 1,96,250 share. If you multiply by here, 1,96,250 shares you will get that here. If you multiply by 8, how much you are getting? You are getting 15,70,000. This much you will getting the same amount. Okay, but you are getting more share 8. But that does not mean we are issuing the shares at discount. Remaining 2 I will call you later that I will recover from you. Okay, I will recover from it. But I am liable to give something the worth of 15,70,000. This is what I have given to 15,70,000. Don't worry about the remaining 2. The paid up is 8. That's it. Remaining 2 that I will call you later. I might be I have issued some shares in the market. I will recover the 2 from them. Suppose I recover only 8 only out of 10. So I will recover 2 from them. I will also recover 2 from you as well that is. Okay. But I was liable to pay you something the worth of 15,70,000. This is what I have already given to you of 15,70,000. Okay. So that means number of shares. Note is given there. Remember, this is the issue of partly paid up share, not issue of shares at discount. Okay. So we're done with the first part that is. Now we have to prepare the account. So many accounts we have prepared here. We are doing the accounting in the books of vendor company. Before come to vendor company, what entry will pass by the purchasing company? Simple. 3 entry. PC due. So business purchase account debit. PC, the amount of PC is how much? 20 lakh 80. So business purchase account debit 2,80,000 to liquidator of vendor company 2,80,000. Only 3 assets taken over that here now is what is that? PP that here now. PP stock and bills receivable. So PP account debit that here now, fixed asset, stock account debit and bills receivable account debit to business purchase. No difference is coming, so no need to write it down that here. Also no goodwill, capital difference is not coming. You know when the difference will not come? If my amount of purchase consideration is equal to net asset, so no difference will come. Why no difference is coming that here? Whatever is the net asset I am taking, the same is the amount of PC here. Difference will not come in that is. Anyways, that difference will not come here. Okay. Now I am paying to the liquidator. So liquidator account debit 20,80,000. I am giving them preference share capital of 5,10,000 and equity share of 15,70,000. That's it. Okay. Now they ask us that here now to close down the books of account of vendor company and these account that we have to prepare here. So remember the steps. We have first of all we have prepared here realization account, equity shareholder account, cash or bank account. Y Limited is a purchasing company. Okay. Purchasing company account at here. Okay. And then we have prepared the shares, equity share that we are going to receive from the purchasing company and the preference share that we are going to receive from. Don't worry. Now, all these accounts should be prepared even though they don't ask you that here. I'm going to say not, they've asked you some account, but we prepare all account. I prepare all account to understand the in totality that here. So we prepare the realization account, equity shareholder account. There is no preference shareholder here. Okay, cash or bank account, purchasing company account, and we are going to receive the equity share preference share from the purchasing company, like a shares in purchasing company. Okay, so these two accounts. Now remember those 12 steps. First, what we do? Transfer all assets to realization account. Okay, so all assets to realize. Okay, for one by one. Or we always remember that we have to transfer it book value only. Okay, I think I didn't mention it that day. It has to be transferred book value. Because whatever value they have taken, I don't care about that here. Because I'm to close down the books of account. So we have to transfer it the book value only, then only the books of account will get closed. Okay, and whatever value that they have taken by the purchasing company, we'll write it down in the PC. So difference will come. That will be either in the form of profit or loss will come. Don't worry for that. Just transfer all assets at the book value to realization account. Asset is debit balance. When we are transferring, we are crediting them. So what should be the entry? Realization account debit to asset. So realization account will be debited 9,64,000. 9,64,000 fixed asset. Okay. Then here stock 7,75,000. Realization account debit to stock 7,75,000. Then sundry debtors 1,60,000. So realization account debit to sundry debtors account 1,60,000. Remember that provision don't transfer 1,52,000. Okay. 8 is it's a provision for doubtful. They have a credit balance. This also will transfer, but separately. Debtors is a separate account. Provision is a separate account. So provision will transfer separately. The provision is credit balance. So provision account, if you want to cancel them, we have to debit them. Provision account debit to realization. So provision account debit to realization. You can see that we credited to the here to realization account 8,000. Then here it's a net amount. Then here bills receivable. So realization account debit to bills receivable 30,000 that here now. Now cash at bank. So cash at bank is not taking over by the purchasing income. I told you we have to make, we don't transfer to realization, we'll make a separate account. So you can see that a cash or bank account balance 3,29,000. Whatever balance left, we'll do the settlement at that. Don't worry. Then we transfer all the item. Now liability side. Equity share capital we transfer to equity shareholder. So equity share capital account debit to equity shareholder account 12 lakh. So equity shareholder account, equity share capital to equity shareholder account, how much here is 10 lakh. Okay. Then here, all this reserve and surplus we also transfer to the owner. Who is the owner? Equity shareholder. So profit prior to incorporation 42,000. And here contingency reserve 2,70,000, profit and loss account balance 2,50,000. These reserve and surplus account will be debited and realization account will be credited here. So no, sorry, not realization. Equity shareholder account will be credited. So profit prior to incorporation account debit, that's the reserve and surplus account debit to equity shareholder. We'll credit to equity shareholder 42,000, 2,72,000, 2,52,000. Yes. Okay. Now what happened that year? Now what happened that year? Now, after this year, current liabilities bills payable that year now. Okay. Current bills payable liability we are going to transfer to realization. So decreasing liability should be debited. So or we are cancelling, it should be debited. So bills payable account debit to realization. We'll credit to realization account by 40,000. Then we have here is creditor. So creditor account debit to realization account. How much here? 2,26,000. Then we have here provision for tax. So provision for income tax account debit to realization. So we have transfer all the assets, then all the liabilities that here, then third all the equity reserve and surplus and equity share capital account to equity shareholder. What was the fourth there? Fourth entry was to transfer the preference share capital to preference shareholder account. There is no preference share capital of vendor company, so no fourth entry. Fifth, PC due. So purchasing company account debit to realization. What is the amount of PC here? The amount of PC here is how much here? 20,80,000. So purchasing company account debit. So you can see the Y limit is a purchasing company. So purchasing company account debit 2,80,000 to realization account. So we'll credit to realization account by 20,80,000. So we'll go to realization account. We'll credit to here 20,80,000. Simple. Remember those 12 steps that is. Then asset not taken over by purchasing company. Yes, there are some asset which is not taken over by purchasing company. So we will recover the amount. Cash account debit to realization. So what are the asset which is mentioned that here now? Okay, these are the sundry debtors rupees 1,50,000. So cash account debit to realization 1,50,000. No cash to debtors because debtors account already closed. We have already transferred to realization. Okay, so cash account debit to realization. Cash account debit to realization 38. And this is also it is bills payable. Okay, wait, it is bills payable. Okay, let one by one. So cash account debit to realization account 1,50,000. So cash account debit to 1,50,000. Realization will be credited here by 1,50,000. Okay. Then entry number 5 is related to the liabilities here. Okay. Realization account debit to cash. Liability which is not taken over by the purchasing company. So what happened that here now? Here bills payable account will be debited. Realization account will be debited by 38. Income tax liability here. So realization account will debit 2,22,000. So realization account debit here now 38. And then realization account debit 2,22,000 of the tax and cash account will be credited by this 38 and 2,22,000. Then they tell us that here now we have also what creditors were finally settled at the cash remaining. Whatever the balance of cash is happened, that will give the payment to the creditor. Okay. So forget about the equity share because we don't have enough cash. So they say whatever cash left at that, some amount which you are liable to pay to the creditor, just pay to them. Okay. But they say after meeting the liquidation expense of rupees 8,000. So what entry we pass for liquidation expense here? Realization account debit to cash. So here, what I will do that realization account debit this liquidation expense 8,000 and cash account will be credited 8,000. If I go to cash account, this is the balancing figure is coming. So they mention in question that here this balance amount whatever left give it to the equity, give it to the creditors. So we are going to pass entry realization account debit to cash. No creditor account debit. Creditor account already closed. Okay. So realization account debit to cash account. If you want, I can tell the logic also. Okay, let me give the logic that. How much I was liable to pay to the creditor? We transfer 2,26,000 here. We debited here 2,11,000. Okay, because that much cash left. So don't worry about the profit or loss on settlement of all these assets and liabilities. That will automatically come in the realization account, the final effect. Okay. Okay. Now we have passed the entries till the effect 8, 9. Profit on realization or loss. So we will find it out. The profit is 3,16,000. Where it will go? The profit will go to equity shareholder. It will go to equity shareholder. So what entry will pass? We have to pass entry. Realization account will be debited to equity shareholder account will be credited 3,16,000. Okay. Now Next is that here 10th is receipt of the PC. So what we are receiving from them, we are receiving from them here. What we are receiving them here, the equity preferentials of 5 lakh 10, equity of 15 lakh 70. We have to pass entry here now. Equity shares in purchasing company account debit, whatever the amount, and preference share in purchasing company account debit to purchasing company. So we have prepared these two accounts, that is equity shares in purchasing company are receiving of 15 lakh 70. Preferential will receive 5 lakh 10. Okay, to purchasing company. So to purchasing company account will be credited by 15 lakh 70 and 5 lakh 10,000. Okay. Next, give it to those relevant person. So I will say that here we are giving to shareholder only. Here even preferential also we are giving to the equity shareholder only, because there is no preference shareholder in vendor company. This share will give it to the equity shareholder. The equity shareholder account debit to this shares account. Okay. The equity shareholder account will be debited here. We are giving them equity shares of purchasing company 15 lakh 70 and preference share of 5 lakh 10. Then any cash left, if any, it will give to equity shareholder. Cash, nothing is left. Whatever left, we have already given to equity to creditors only. So no cash left here. Done. So all account get closed. That if you see that all account get closed, your 14 marks is here now. This is these approach you have to follow that here. Okay. So we have solved that here question number 28 that here now. 29 that. But remember that question number 30 is I am giving as homework. You'll say, so why? I mean, the figures are different, but the IT favorite question that almost the same question what we have solved in question number is 29. So you can see that is similar to question number 29. Similar to question number 29 that here now. Okay, similar to question number 29. Okay, you got the point here now. Okay, so you are going to solve that almost same question that here. Okay, so it is homework that here. Okay, it's almost same question. Amounts are different. Almost same question that here. Okay, now I will come to question number now 31 and then 32. Okay, then we'll discuss about the how to do the accounting in the books of purchasing company by which method. Amalgamation, nature of merger, I have not yet discussed with you. No problem. Now come to question number 31. So P Limited and Q Limited. Okay, question number 31. P Limited and Q Limited were carrying on the business of manufacturing of auto components. Both the companies decided to amalgamate, and a new company PQ Limited is to be formed with an authorized capital of rupees 10 lakh divided into 1 lakh equity share of rupees 10 each. So it is the case of amalgamation. P Limited and Q Limited are coming together, form a new company PQ Limited. Okay. Now the balance sheet of the companies are given. So they have given us the balance sheet of both the company. Both are the vendor company, P and Q. So P Limited, equity and liabilities, shareholders fund, share capital 1 lakh 40, reserve and surplus, profit and loss under the reserve and surplus 30,000. Non-current liabilities 8%, debenture, secured debentures 1 lakh 10. Then current liabilities 54,000. Now asset, non-current asset that here now is property, plant and equipment, building at cost less depreciation means WDV 1 lakh, plant and machinery at cost less depreciation 25,000. Current asset, then they have inventories here 1 lakh 35,000, trade receivable 44,000, cash at bank is 30,000. Then Q Limited that here now. Equity and liabilities, shareholders fund, share capital 2 lakh 50,000, reserve and surplus, general reserve 1 lakh 20, profit and loss account 35,000. Then here current liabilities here, trade paper 1 lakh 40,000. Assets here, non-current asset, property, plant and equipment, building at cost less depreciation 1 lakh 90, plant and machinery at cost less depreciation 80, furniture and fixture at cost less depreciation 25. Now the current asset is inventories is 50,000, trade receivable is 1 lakh 42,000 and cash at bank is 58. Now understand the both balance sheets of the vendor company. Okay. Now they say the asset and liabilities of the existing company are to be transferred to the at book value with the following exception. So generally the vendor company transferring their asset and liability at book value only, but with certain exception. So they say goodwill of P was worth rupees 50 and Q 1 lakh 50,000. They have given the amount of goodwill here. So when you write it down, when we calculate the amount of PC, the goodwill will also come that here. Okay, goodwill will come in both the cases. The goodwill will come that here. Okay. Okay, goodwill will come there. Okay, they have given the amount of goodwill, don't worry. Then the furniture and fixture of Q Limited were valued at rupees 35. The Q is the second company, furniture and features. This is okay. Point number B. Okay, point number A. Point number A. Here they has given us the amount of goodwill. Okay, now the debtors of P Limited are realized fully and the bank balance of P Limited are to be retained. by the liquidator, and then it should be the and the creditor, just cut it up, and the creditor are to be paid out of the proceeds thereof. That is very interesting that, in point number C, they're telling us that now the debtor will be realized and the bank balance of P Limited are to be used to retained by the liquidator. And out of these amount, they are going to pay to the creditor. So they are giving us the clue that here, in case of a P Limited, that here they have not taken over. They have not taken over that here. Point number. Just give me a minute. They have not taken over here the debtors, bank balance, and creditor of the P Limited. You see why, sir? Read this point carefully. Point number C, that here the debtors of P Limited are to be realized fully, and bank balance of P Limited, that here now, are to be retained by the liquidator. It means that here now they are not transferring these bank balance debtors to the purchasing company, and they say that a creditor are to be paid out of the proceeds, and we are doing the settlement out of the proceeds. It means we are doing the settlement to the creditor. So these three items, debtors, cash and bank, and creditor, is not taken over by purchasing company in case of P. P and Q both are the vendor company, but in case of a P, they are not taking these three items, The debenture of P Limited are to be discharged by the issue of 8% debenture of PQ Limited at a premium of 10%. So basically, we are taking over the debenture at a premium of 10%, Now understand that here. So here they are talking the P Limited. So there's something about, D point, Now they ask you that here, you are required to calculate the basis on which the shares in PQ Limited will be issued at par to the shareholder of the existing company. How many shares? But how will you find the amount of PC that here? So amount of PC, can we find it out? How? Payment basis, can we find it out by the payment basis? The answer is no, we cannot find it out by the payment basis that here now. The reason is that we are going to find it out by they have not mentioned that here, how many shares we have to give them. So we have to find it out. If we cannot find it out by the payment basis, that how many share debenture we are giving them to the shareholder. Whatever we are giving to shareholder, that is the only amount of PC. But here we cannot find it out that by the payment basis. So how to find it out that still whatever the amount of PC will give to the shareholder only. But to decide the amount of PC, we have to find it out by the net asset basis that. So first, then they ask you to prepare the balance sheet. I will come to that net asset basis, the one by one. So let's take first of the P Limited. So net asset, all assets and liabilities. Let's take one by one. Take asset first. The building is 1 lakh. So I will write it down here. Building 1 lakh. Then here, plant and machinery 25. Plant and machinery 25. Now goodwill is mentioned in point number A already. So goodwill is how much here? In case of P is 50,000. So goodwill, you can see that here, the 50,000. Now remember that here now, inventories, 1 by 1,35,000. So here inventory is 1 lakh. Remember that here these debtors, cash, and here creditor is not taking over by the purchasing company. So we'll not write it down like this. Why? Because these three items is not taking over by the purchasing company. So it is not taking over by the purchasing company. So we'll not write it down that here. Because it is not taking over by. That's why it is here. Furniture is different thing, which is only in the case of Q only. If there is no trade receivable and the cash, because which is not taking over by the purchasing company. Total asset, this much is taking over by the purchasing company. Now go on liability side. The trade payable is also not taking over by the purchasing company. They are taking this debenture, and they are taking this debenture at what? 10% premium. So here 1,10,000 plus 10%. That is coming how much? 1,21,000, and this is the net asset. 3,10,000 minus 1,21,000. Now we are giving them the shares of rupees 10 each. It is mentioned that here. Important. We are giving the shares at par, and the share is of rupees 10 that here. So this much of shares we are giving them. Now we'll do the calculation of Q. Now come to the balance sheet of Q. Building 1,90,000. So building 1,90,000. Then here plant and machinery 80,000. Plant and machinery 80,000 here now. And then furniture they mentioned in point number B. They are taking the furniture at what price? 35,000. So 35,000 here. We are not closing down the books of account. We whatever value we are taking, we just have to write it down at that agreed amount. Then here we have inventories 50,000. 50,000 inventories that here now. Then we have trade receivable 1,42,000. 1,42,000. Then we have a cash at bank 58. Here in case of Q, all assets they are taking asset liability. 50 8, not total. Not, there is no debenture. Now liabilities, if I go there, we have a liability of 1,40,000 trade payable. So we have a liability of 1,40,000. This is the net asset and the share is of rupees 10 that here. There is this much number of shares that here. Okay. Now we have calculated. Now some of you might get confused that it generally comes in the mind of the student that here, sir, I have a doubt. I ask, what is the doubt? Sir, you said that here, whatever we are giving to debenture that here, that is not a part of the PC, but you find it. Do you use this 1,55,000 even though you are finding out the amount of PC? I agree that here. But remember that here we are just finding out the amount of PC. We don't consider in the amount in PC if we are giving to the shareholder. I mean to say that here now, whatever amount we have find it out here, this 1,89,000 and 5,65,000. These amount we are not giving to debenture holder. These amount we are giving to shareholder only. Please understand. So that 1,21,000 just to take into consideration, because we have to find it the amount of PC on the basis of net asset. That's why we take whatever asset and liability is taken over by the purchasing company. We have to write it down all those at the agreed price that year. Okay. So don't get confused why you have debenture you have written. No. I am finding the amount of PC. But whatever the amount of PC is coming, we are not giving this amount to the anyone other than the shareholder. This amount will be given to the shareholder only. That's okay. Understand? Don't get confused with 121. We write it down all asset and liability when we find it the amount of PC by net asset basis. Okay. Now they ask you that here the second thing is to draw up the balance sheet. When they ask us to draw up the balance sheet that here, but remember it is draw up the balance sheet in the books of PQ Limited, the purchasing company. So it is a case of amalgamation that here two companies P and Q, they come together and form a new company. Very simple. Now why? Because it's a new company. New company. So when I say that here it's a new company that here now, what is going to happen when I say it's a new company that here now? It means that here now, this new company, it means that here now they don't have any existing balance sheet, correct? So we don't have, in case of absorption, we have to worry that purchasing company has their own existing balance sheet and the transactions happen at the time of absorption. Both of them we take into consideration and we write it on the figure in new balance sheet. But here there is no existing balance sheet of PQ Limited. Okay. So how to, very simple that here, just we have to take the figures from here. Okay. Okay. Like the goodwill, 50,000. Okay. One more thing is that here, whether the doubt is coming in your mind, sir, but we have to make a working note because we acquire a P Limited and Q Limited. In second entry might be a difference. So either goodwill or capital. Let me tell you, there is no difference. Why? Because whenever that here, your purchase consideration is equal to net asset, difference will not come. Difference will not come. No difference. Why? Whenever the PC is equal to net asset. Okay, because the amount of net asset is this much, that is the amount of PC only. The difference will obviously not come that. Okay. Now here, whatever asset we are taking, that much only we are giving to them. So difference will not come. So no need to prepare that working note. Okay. Now here, we will write it down one by one. Okay. So here we have here a goodwill 50 and 1,50,000. That you can see the 2 lakh. Notes account, we can prepare that. Okay. Now building 1 lakh and 1,90,000. So note, okay. Notes account number 3. Okay, 1 lakh and 1,90,000, 2,90,000. Then here, plant and machinery 25,000 and 80,000. So 25,000, 80,000, 1,05,000. Then we have here furniture here 35,000. So furniture you can see that here now 35,000. Now we'll do the total of these items. That is PP 4,30,000. So PP will come in balance sheet 4,30,000. Then we have taken over the 1,35,000 and 50 inventories. So 1,35,000 plus 50, that will come 1,85,000. Then your trade receivable 1,42,000. 1,42,000 is trade receivable only. Cash at bank here 58. Okay. Then here is liabilities, debenture 1,21,000. Debenture 1,21,000. Trade payable 1,40,000. Trade payable 1,40,000. Shares we are giving 1,18,000 and 5,65,000. So total is it's authorized is given, so we have to write it down. Okay. So we are giving we are giving them total this much of shares that here. Okay, this much of shares 7,54,000. If we do the total of 1,89,000 and 5,65,000. Simple. Okay. Now whether the doubt is coming in your mind that here now, sir, is prepare the balance sheet that here. But you have not done anything of these three items which is not taken over by the purchasing company, these debtors, creditors and cash of the vendor company, because we are not doing the accounting in the books of vendor company. If you are doing the accounting in the books of vendor company, what is the logic? All asset transfer at book value, all liabilities transfer book value to realization account. Then equity share capital, reserve and surplus transfer to equity shareholder. Third, fourth point, preference share capital will transfer to preference shareholder. Fifth, PC due. Sixth is that the PC due. Then here we write it on the asset not taken over by the purchasing company. Then this will come cash account debit to realization. The liability is not taken over by the purchasing company. Realization account debit to cash, like that. Okay. Now very simple. Okay. Now next question that here now come to question number here now. Oh, they have asked the entries as well. That okay, I think, but okay. Third point, write up the journal entries that here. So let's see that in the books of only one company, P Limited. Okay, interesting. So P Limited not given all assets. So first they will transfer, simple it is. Okay, realization account will be debit to building, plant and machine, inventory, trade receivable. Even though not taken over by the purchasing company, we have to write it down here. And remember that here now, all these will be transferred at book value because the vendor company is going to close their books of account. Okay, so if you see that, let me change how many colors. Okay, now here see those 12 steps that here. Okay, one by one. So we'll transfer of the P Limited that here. Okay, transfer the P Limited that here now is the building at what 1 lakh, plant and machinery 25, inventories, trade receivable, but we don't transfer realization to cash to realization because it is not taken over by the purchasing. All we have to transfer even though not taken over by. So you can see that here now is a realization account debit to building account to plant and machinery to inventories and to trade receivable. Then what happened here now is here is the trade payable is 54, debenture is 1 lakh. So liability account debit to realization account. So you can see that here now liabilities account debit 1 lakh 10 and trade payable to real. You'll say no sir, but here they have taken some other. We don't care. We are going to transfer it book value only. Remember that because we are closing the books of account. Okay. Now here then equity share capital, or let me discuss from here only. What we do, equity share capital, the third part. Equity share capital account debit or profit and loss account. They might have, but yeah, they have a profit, single entry that they have passed. So equity share capital account debit to equity shareholder, profit and loss account debit to equity shareholder. Okay, they don't have any preference share capital. That's a no fourth. Now PC due. So purchasing company account debit to realization account 1,89,000. We're talking the P Limited only. Okay. Now asset not taken over by the purchasing company, which is debtors. So cash account debit to realization account. Now liability is not taken over by the purchasing company. So realization account debit to cash. If nothing is mentioned, we'll assume that at the book value only we receive. So data is the 44. Nothing is mentioned how much we have realized. So we'll assume that the same amount of the data we realized, same amount of creditor we paid. Okay. So asset not taken over by purchasing company, liability is not taken over by the purchasing company. We pass that. Now here the profit on realization. I will profit on realization. The realization account debit to shareholder account. Now PC recover. So shares in purchasing company account debit to purchasing company account. Done. At the end, whatever shares that we have received, we will give to the equity shareholder, and whatever cash that we have in the bank balance, that also will give to the equity shareholder. They have passed a combined entry here. Okay. Done. Nice question. Now come to question number 32. What question number 32 says? The following are the summarized balance sheet of X Limited and Y Limited. This question is also given IC study material, but they have given only the accounting in the books of one vendor company. Okay, I discussed both of them. Very interesting question. Simple but interesting also. Now two companies X and Y. Liabilities, they have share capital 1,50,000, profit they have 10,000 dash, creditors 25,500, loan X dash and 15,000. Now understand that. Both are the vendor company here. Okay, the X Limited loan here is mentioned in the, this is liability side. Okay, then is the asset side. So 15,000 is mentioned in the books of Y Limited. So it is a liability for Y, which is liable to pay to X. Okay, now asset side, sundry asset 1,20,60,000. Now loan Y Limited, it is appearing on asset side. It means it is recoverable, loan given by X to Y. So that's why it is asset for X and it is liability for Y. Profit and loss account, one has a loss of 10,000. Okay. Now they say that a new company XY Limited is formed to acquire the sundry asset and creditor of X Limited and Y Limited, and for this purpose, the sundry asset of X are valued at rupees 1 lakh of X Limited. Okay, so they say the new company that they have formed is the XY Limited. They will take over the sundry asset and the liabilities of the X and Y Limited, but the valuation we have to do for the X 1 lakh. What is the depth point? I will come to that here. Okay, I will come to this depth, the point that I highlighted, which is the main point that you know. So when I will calculate the amount of PC, I will say net asset minus liabilities that is. Okay. So your sundry asset is given that 1,60,000 because for X we have taken into consideration 1 lakh only. How I find it out that here, you can see that sundry asset is 60 here, but for the X they have taken 1 lakh. They tell us to take 1 lakh. And creditor here 25 and 5. So you can see that here now is 1 lakh and 60, and here 25 and 5. This is the amount that they have. A purchase consideration is how much? 75,055 is the amount of PC. Simple. Okay. Now, what is this? I will discuss with you this depth point. Okay, I will discuss with you this depth point at that. The first, do in the books of, let's say, the here ledger in the book, they ask you only for the X, but I prepare for X and Y both. Okay. Now, let's talk about X only. So they say first X. So I will transfer this, let's say, asset. So realization account debit 1 lakh 20 against the sundry asset, and loan 15. So 1 lakh 20 and here 15. Then here live share capital will go to shareholder account, share capital to shareholder account 1 lakh. Then they have here profit and loss account. Profit and loss account debit to shareholder account, how much? 10,000 here. Okay. Creditor account here, so it's a liability. The creditor account debit to realization, transfer to realization 25. Okay, done. Now asset liability shareholder we have transferred. Now PC due, so preference shareholder account, the purchasing company account debit to realization. How much is the PC of X? Is 75. So purchasing company account debit to realization 75. Okay. Now all asset liabilities taken over by them. Okay. Now what happened that here now is okay. One thing is about the debt I will discuss. Except debt account has been closed, we have transferred to the realization account. Okay, but I will discuss with you. Now what happened? It is mentioned that here now the debt due to X is also to be discharged in the shares of XY. So they are telling us that here, whatever is the debt is of 15,000. For X it is asset, for Y it is liability. They say it has to be settled in the form of shares in XY. It means, suppose if we recover the amount from, we all are X, suppose if we recover the amount from Y, so we are going to pass the entry cash account will be debited to realization account. Okay, cash account debit to realization. But they say no cash account debit. They say you are going to receive the shares of the XY limit. So I will say shares in XY limited account debit to realization account. Like that for Y, if they are going to pay, what entry they pass? Realization account debit to cash. Okay, but the realization account debit to cash, but they will not credit to cash. Whatever shares they are going to recoverable from the new company, this much of share of the debt they will not recover. So basically the new company is doing the settlement of their debt in the form of shares. Suppose I am the purchasing company, two party X and Y. I will tell you X, okay, how much shares that 15,000 is recoverable from him? Yes, they say I will give 15,000 shares to you and I will reduce the 15,000 shares from him. You got the point? Okay, what they are doing. So here shares, the X will get, realization will credit, and realization account debit shares in XY limit. So here you can see that here PC due with the shares in PC due we have passed the entry. So we recover the 75,000 first. The shares in XY limited account debit to purchasing company. But these 15,000 we are going to recover for the debt. So now imagine, forget about the we are receiving the form of shares. If we receive the cash account debit to realization. Here instead of cash we are receiving shares. So shares in XY limited account debit to realization. Okay, done. The balance will transfer to shareholder account, this, and then final settlement, the shares that they have received, it will given to the shareholder. Okay, now if we go to the vendor, this next vendor company, so here they are going to pass entry realization account debit to, this is a new point on the shares. So they are doing this at all asset liability same, they will transfer there, and realization account will be debited to shares. The receipt just shares which is recoverable was 55,000. In the case of what? Y. But he will recover 15 will be adjusted, he will recover only 40 and he will give 40 to the shareholder. Okay. But I have prepared the pass accounting entry in both of them here. I have prepared the balance sheet as well. Instead of just asked to pass the entry in the books of X Limited, but I have done for both of them to get a complete understanding here. Okay, very interesting question. Okay. Now, next question is on the merger that here. Okay. If you remember that here, how we started our this marathon that here. I told you that here now. The account overview that here. Okay, the purchase, we have discussed how to do the accounting in the books of purchasing company in the case of amalgamation nature of purchase, and vendor company, how to do the accounting in the books of vendor company. Now I'm discussing amalgamation nature of merger. When we follow amalgamation nature of merger, when all the these five conditions are satisfied here, we have to solve by the pooling of interest method. So what we'll do that here now, we'll discuss the amalgamation in the nature of merger. Come to page number 34. Now we'll discuss how to do the accounting in the case of amalgamation nature of merger in the books of purchasing company, and then we'll discuss the question on this. Okay. So accounting for amalgamation nature of merger, when it happened when all five conditions for amalgamation, the nature of merger are met that year. Okay. Now we will discuss how to do the accounting. That is the main part to understand. The first is same. The business purchase account will be debited and the liquidator or vendor company will be credited here. Now what happens is second entry, only the difference is that here, which is highlighted here with this color. Okay. Now, if first, what is the first difference is that here now, in case of a purchase method, we take asset and liability, not reserve, but amalgamation nature of merger will take all asset, all liabilities at book value. You can see that here I have not written agreed value. What I have written that here? Book value. So in case of amalgamation nature of merger, we take all asset and liability at what? At agreed value. Or in amalgamation nature of merger, we take all asset and liability at book value. Okay. And also we take the reserves also. We take what we do that? We take all the reserves. So when we pass second entry here, we are going to record all the assets, all the liabilities at book value, including what? Reserves also. This is the first point. Now, if my debit side gets short, that is, credit side is simple. If the credit gets short, same logic, the credit will credit to capital reserve account. But if the debit gets short, that here now, we don't write it down here goodwill account. We don't write it down here the goodwill account if the debit is short. What we do that here now, if the debit is short, that here now, is we will first adjust against what? Adjust against what? The capital reserve. What does it mean that here now? If we this amount, if the debit gets short, suppose if we have a capital reserve account already existed, we'll deduct from. And then we will deduct from, if we don't have a capital reserve, we'll deduct from the revenue reserve account. If we don't have a revenue reserve, then we'll deduct from the P&L account balance. So, did adjust against deduct. These are priority wise. So, if the debit is short, what we'll do that here now? First, we'll try to adjust against the capital reserve, then revenue reserve, and then what here? The profit and the loss account here. Okay. So this is the difference. We don't write it down here goodwill. Now the same thing is that now when we discharge the PC, liquidator account will be debited. Equity share capital, preference share capital, debenture. If we are giving them, it will be at face value. Securities premium will go to premium account, cash or bank or other asset. And this is also difference that here. Okay. Whatever is the difference, let me highlight here. Okay. Now, if the liquidation expense there, in case of amalgamation nature of purchase, we adjust in goodwill or capital reserve. Here, if liquidation expense is paid by the purchasing company, P&L account or general reserve account will be debited. So whatever I highlighted here with the green color, these are the only new points and all other thing is the same. Almost 95% is same that here. Okay. Now, what we'll do that here, we'll solve a question on it. And what are the differences if they ask you that in an examination that here now? The difference is that here, between the amalgamation nature of merger and amalgamation nature of purchase that here. Now, difference is that here now, transfer all assets and liabilities, and here in the amalgamation nature of purchase, not necessary that all assets and liabilities is going to be transferred. Shareholder of transfer company, then at least 90% equity shareholder will become the equity shareholder of the vendor of the purchasing company. Here, not necessary that equity shareholder will become the equity shareholder of the purchasing company. Purchase consideration, here to the equity shareholder, we have to give them the equity shares only. Fractional in share, we can give them cash. Here it is not necessary. To the equity shareholder also, we can give anything. Same business should be continued, no requirement here. Recording here, in case of amalgamation nature of merger, everything should be recorded at asset and liability book will except for the uniformity accounting policy if needed that here. Okay. Now here what is going to happen now here? It will be recorded at agreed value. Okay. Whatever the amount is decided. Here we do the accounting in the books of purchasing company by pooling of interest method. Here the purchase method. This is what I have discussed with it. This is a pooling of interest method. Okay. Now what we'll do that here, we'll go to this 50 question, come to question number 33 that here. Okay. What it says that now, Super Express Limited and the Fast Express Limited were in competing business. They decided to form a new company named Super Fast Express. It is a case of amalgamation. The balance sheet of both the companies they have given us that now. Equity and liability shareholders fund share capital 1, 20 lakh, 10 lakh. Reserve and surplus to 1 lakh and 2 lakh 60,000. Non-current liabilities, long-term provision 1 lakh. Current liabilities, trade payable 60,000 and what? The 40,000 here. Now here, non-current asset, property, plant and equipment 14 lakh, 11 lakh. Intangible asset dash 1 lakh. Now here current asset, inventories 3 lakh 40,000 here, and then trade receivable 2 lakh 40 and 40. Cash and cash equivalent 3 lakh 20 and 20,000. The notes to account that they have given, share capital, equity shares of rupees 100 each, 20 lakh, 10 lakh. reserve and surplus, insurance reserve, employee profit sharing reserve, reserve employee profit sharing reserve, reserve account. Okay, then the surplus. But remember that here now, here in case of amalgamation nature of merger, we are going to take all the asset liability, including what reserve. Long-term provision, okay. Then here PP, intangible cash. These are only what here? These are the total here. Okay, these are the notes to account that here. Okay. Now long-term provision here, provident fund. Okay. Now PP, land and building, plant and machinery, intangible asset, goodwill, cash and cash equivalent, cash at bank and cash in hand here. Now they say the asset and liabilities of both the company were taken over by the new company at their book value. Book value, this is what happened in case of amalgamation nature of merger. The companies were allotted equity shares of rupees 100 each in lieu of their purchase consideration, rupees 30,000. 20,000 for super fast express and 10,000 for fast express. There is one error here. I mean, a mistake. What is the mistake which is mentioned in IC study material? They say the PC of rupees 30,000 that here now. And this 20,000 10, it is not possible that here. I am to say that here now. The PC basically is here the 30, or you can see the shares that here, or you can see it's amounting, it's a share 30,000 shares. Okay, of rupees 100 each. So 20,000 is for the super fast and 10,000 is for the express. That not the amount, it's basically shares are there. Okay, so a PC is also given 20,000 for one company and 10,000 shares for another company, and they asked you to prepare the balance sheet. So very simple is that here. We just have to take all the things that here. We have just to merge them. So one by one. Okay, let's start from the asset here. Okay, both company here. So PP 14 lakh and 11 lakh. How much it will come? 25 lakh. So you can see that PP 25 lakh. Now, then we intangible asset on the 1 lakh here. So 1 lakh here intangible asset. Then we have here inventories here 3 lakh and 40,000. So it will come 3 lakh 40,000 inventories here. Okay. Then we have here is trade receivable 2 lakh 40,000 and 40,000. So 2 lakh 40,000 40, it will come 2 lakh 80,000. Okay. Then we have here cash and cash equivalent 3 lakh 20 and 20, it will come 3 lakh 40,000 here. Okay, 3 lakh 40,000 here. Then here liability side that here now is share capital. We are giving the PC to them. How much is PC? That is also a 20,000 and 10,000 shares. The 30,000 multiplied by that is coming 30 lakh. You can see the share capital 30 lakh. Then here, remember, we are going to take all the reserves here, beta. Okay, 1 lakh and 2 lakh 60. The notes to account is given. Seriously, notes to account number 2, you will see that here. We are going to take all the reserve account, surplus, insurance, employee benefit. All reserve and surplus is going to take over by the purchasing company. Okay. So here reserve and surplus 3 lakh 60. Because we are doing the amalgamation nature of merger it is. Okay. They mentioned that solve by pooling of interest method. Okay. Then we have long-term provision 1 lakh. So long-term provision 1 lakh. And then we have a trade payable 60 and 40,000. That will come how much here? 1 lakh here. Okay. Done. So this is the amount. This is the amount that they have here. Okay. Now 35 lakh 60,000. The total balance sheet done. Tell you. Simple it is that here. Only difference is that if I take all reserve and surplus, but the difference is not going to come because we have taken all the asset and liability book value only. So net here, if you take this, if you do that here their net asset means all these assets 22 lakh 60,000 minus these three things that we have taken that here. The net asset is coming. How much is 20? Like if you pass second entry also, the difference is not good to come because there 20 and 30 is there. The net will come 30, 20 and 10, 30, and the PC is also 30. So that's why the difference is not coming there. Okay. Now come to here the question number 34. Interesting question. Now listen carefully. This is the following where the balance sheet of P Limited and V Limited as at 31st of March 2024. So two company P Limited and V Limited and rupees are in lakhs that here. So equity share capital fully paid up shares of rupees 10 each 15,000 6,000. Securities premium 3,000 dash. Foreign project reserve dash and 310. General insurance 9,500, 3,200. Profit and loss account 2,870, 825. 12% debenture dash 1,000. Now bills payable 120 dash. Sundry creditors 1,080 and 463. Sundry provision that is 1,830 and 702. Now we have an asset here. Land and building that is 6,000 dash. Plant and machinery 14,000 and 5,000. Furniture, fixture and fitting 2,304, 1,750. Stock 7,862, 4,441. Then the data here 2,120 and here this 1,020. Cash at bank and bills receivable. Anyways, now these asset and liabilities given there. They say all the bills receivable held by the V Limited where P is accepted. That is nothing but a mutual debt. It means all the bills receivable of V Limited that here basically is the P's acceptance. Acceptance means it is bills payable for them. Bills payable. So all the bills receivable of V is actually the bills payable of P. Okay, it's a mutual debt. We'll cancel them. So on 1st of April 2024, P Limited took over the V Limited and amalgamation nature of merger. It is specifically, generally in the case of merger, they will specifically mention in question. So they have taken here all the purchasing companies P and vendor companies P, V. Simple, purchasing is P, vendor is V. They say here that it was agreed that in discharge of consideration for the business of P would allot 3 fully paid up equity shares of ₹10 each at par for every 2 shares held in V. So for every 2 shares in vendor company, they will get the 3 shares in the purchasing company of shares of ₹10. It was also agreed that 12% debenture of V Limited would be converted into 13% debenture of P Limited in the same amount and denomination. Simple, not the same income, same amount. 12% will be converted into 13% debenture. Okay, how we calculate the amount of PC? Expense of liquidation also mentioned 1 lakh, okay, which is going to bear by the purchasing company. Journal entries in the books of P Limited. P Limited is a purchasing company. Okay, and then balance sheet after that. Okay, no problem. Now, so first of all, amount of PC. For every 2 shares, we are giving them 3 shares. So how much is the share capital of a vendor company here? The share capital vendor company is 6,000. Okay, so 6,000 divided by 2 multiplied by 3. So you can see that. Okay, 6,000 is the amount. For every 2, 3, 9. Okay, this is the amount of PC. We'll pass entry. What first entry we pass? The PC due. So we are going to pass the entry here. Business purchase account will be debited and liquidator of vendor company will be credited. So business purchase account debited here by 9,000 and liquidator account here credited by 9,000. Now second is that here now plant and machinery account debited that here now will be debited here by how much here? Same exact figure we are taking, the book value we are going to take. We just have to take from here. So plant and machinery asset is how much? 5,000. So you can see that here 5,000. Then we take furniture 1750. We take furniture 1750. Then stock 4041. Stock 4041. Then debtors 1020. Debtors 1020. Then here cash at bank 609. Cash at bank 609. Bills receivable 80. Mutual debt will cancel later. Always remember the mutual debt. First we take asset and liability, then we'll cancel the mutual debt. Okay, that 60. Now liability here. Then we have here, we are going to take all the reserves also. Okay, so 310 foreign project reserve, general reserve 3,200. So this foreign project reserve. Then here general reserve, write it on inner column. I will tell you why. 3,200. Okay. Then we have here profit and loss account 825. Profit and loss account 825. Now 12% debenture 1,000. 12% debenture what here? How much here? 1,000 is that now. Then we have bills payable which is dash. Then we have sundry creditor 463. Sundry creditor 463 that here now. Okay. Now sundry provision is 702. Sundry provision 702. Okay. Bills payable also 9,000 mentioned that here now. Why I have not written bills payable? I miss bills payable. Why they have write a bill, not bills payable? This is business purchase. Okay, business purchase. Okay, so business purchase we credit, yes sir. Now understand that here, if you do the total of these all these items here, okay, it will come 12,500. If you do the total of these all these items, not these 200 and this 3,200 also, which is I have written inner column, that is coming 15,500. So my debit side is getting short. So debit is short by 3,000. So what we do if debit gets short here in case of amalgamation nature of merger? Adjust against the capital reserve. So do we have capital reserve? I will see that here. Whether I have any capital reserve. Whether do we have any capital reserve? No, we don't have any capital reserve. Sorry, we don't have any capital reserve. Then here a revenue reserve. Yes, you can find it out that way. We have taken the general reserve here. Okay, general reserve. It's nothing but a revenue reserve. So these 3,000 will be deducted from them. We are not going to write it down here goodwill. Okay, this is the new point that we have. So deduct this 3,000, outer column 200 will come. This is what we do in case of amalgamation nature of merger. Now discharge of PC. Liquidator of vendor company account debit 9,000. We are giving them share cap, equity share capital 9,000. Okay. There is a mutual debt of 80. How we find it out 80? They say all the bills receivable held by V Limited that all the bills receivable held by V Limited where P's Limited acceptance that here. What is going to happen now here? The bills receivable are held by V Limited, where P's Limited acceptance that here now. The bills receivable of V Limited is how much here? V is a vendor company. Bills receivable how much here? 80. So these are bills payable for the purchasing company. But you say no, so their bills payable is much high. No problem. They may have some other bills payable also. No? So that bills receivable of V is bills payable of P. That is nothing but the mutual debt. So bills payable, we are going to cancel them. Decrease in liability. So bills payable account will be debited and bills receivable account will be credited. Now the last point is that now is the amalgamation expenses or liquidation expense of rupees 1 lakh. Do you remember that I told you that here it will be adjusted liquidation expense in the P&L or general reserve. So you can see that here I have passed general reserve account debit 1 to cash account. Simple. Okay. This is what we do that here now. Now we have to prepare the balance sheet here. Okay. So when we prepare a balance sheet, it is a one company, P Limited take over the V company. It's a case of absorption. Okay. We are taking one existing company, taking another existing company. So when we prepare a balance sheet that here, so already the balance sheet is existed of the one company, that is the purchasing company. Okay. So here how much we have to take into consideration that also. This 15,000 plus here share capital 6,000, 9,000. 15 plus 9, 24. 24,000. Okay. Now here is securities premium account 3,000 here. It will go to reserve and surplus. Here securities premium that I have taken any securities premium? No. So I will write it down here, the 3,000 here. Okay. Then here we have here foreign project reserve. I don't have, but from the vendor company I take foreign project reserve is 310. Total is 310. 310. Okay. Now here is general reserve. I have 9,500 plus this 200. 9,700. Okay. Minus I have debited here. Okay. Minus 1. So 9,699. Okay. Then we have here profit and loss account 2870. Okay, profit and loss account 2870 that here. Now this is 825 plus 825. Now 3695. 3695. Very simple. Okay, now just we have to take a figure and add or less and write down. Now 12% debenture I don't have here. Okay, but they have mentioned. Okay, no problem. 12% debenture that we have taken 1,000 that here. Okay, we have taken directly. They have written 13%, but they say 12% will be converted into 30. So we can also write it down here 12%. Then we cancel 12% when issue 13%. That is also correct. Okay. Anyways, but the same effect. So 1,000 there. The 13% debenture long-term borrowing this. Okay. Now here we have a bills payable of 120. So 120 that here now. But here bills payable I have debited here by 80. So 120 minus 80, 40. So bills payable will come here. This 40. They have written trade payable under trade payable. Okay, 40 that is. Then we have here is sundry creditor 1080 plus here sundry creditor that is 463 plus 463 that here now. Okay, 1543 sundry creditors that here now. Okay, creditors here 1543. Okay, 1543 plus 40. Is there an error? Just give me a minute. Okay, it should be here 1583. Yes. Okay, do the correction there. This is 1583 there. Okay, done. Then here, after this, again we'll go to the balance sheet here now. So we have here sundry provision 1830 plus here 702. So 1830 plus 702. That is coming 2532. 2532 that here. Okay. Then asset side, land and building 6,000. Same that here 6,000. Then here 14,000 plus their land and plant and machinery is 5. So 14 plus 5 that is coming how much? 19. Then we have furniture 2304 plus 1750 that here. Okay, 1750. Okay, 4054. Okay. Now 7862 plus that here now is 7862 is what here? That is stock. So plus 4041 plus 4041. That is coming 11,903. Simple. Then we have here datas 2120 plus here 1020. That is coming 3140. 3140. Then we have cash at bank here 1114 plus that here now is 609. Now I think we have credited here. We have paid this one also. The minus 1. So 1722. 1722. Simple it is, yes. Okay. All the item now here, see whether all are tick. We have debited business purchase here, but we credited here. Here liquidator we credited, but we liquidated, we debit. All the item we have considered. Bills receivable also we have taken 860, 80. Yes, okay. Now done. Done. Okay, we have credited bills receivable. I have not taken bills. Okay, bills will get cancelled. Okay, no problem. Here debited and then credited, so that becomes 0 that here. Okay, done. So very simple is that here now. You just have to do the practice, which is very important that here. Okay. Now all the questions covered. Now internal reconciliation obviously separate class I will take for that. Now I will see that here if is any point pending here. Okay. So come to the pages, first page, all the points that we have covered here. Okay. Now one by one. First page, all we have covered here. Okay. Then here, okay, then here we have here is second that here, yes, done. Okay, now I already covered these points that here. When it's come to the accounting for amalgamation nature of purchase that here, you know that here now. Asset and liabilities here of vendor company are recorded in the book of the purchasing company at what? The agreed value that here. The reserve of the vendor company except this, what is statutory reserve, I will come to that, are not included that here. The one point that I have discussed. Reserve we don't include generally. Excess of PC or the net asset we adjust in goodwill. Okay, if purchase consideration is less than the net asset, we adjust in capital reserve. Basically second entry. Debit short, goodwill, credit short, capital reserve. Discuss all the entry, one entry is pending. Statutory reserve, I will come to that. I will discuss this at these point. Okay. Okay, I will discuss this. Don't worry. At the end, it is mentioned there. Okay. Now, accounting for amalgamation nature of merger. All these points we have discussed. In the case of amalgamation nature of merger, we have to follow pooling of interest method. We take all assets, liabilities, and all reserve at their book value. No goodwill account is created. If debit side gets short, we adjust in capital reserve, or if not possible, revenue reserve, then again P&L account. All entries discussed. Difference we have discussed. Okay. Now accounting in the books of vendor company, we have already discussed all these 12 steps there. Okay. Now special transaction first we have done. Third also we have discussed. Now only one is pending that I already discussed is statutory reserve. You can understand that here. Now what happened that here now? When I talk about statutory reserve, okay, let me write it down here. Okay. Let me write it down here. Now understand this. When we talk about here, statutory reserve. Now, two possibility whether we are doing accounting in the, I mean to say amalgamation nature of merger, in the nature of merger, in the nature of purchase. Okay, amalgamation nature of merger and amalgamation nature of purchase that is. Okay, now understand this one. What happened is that here now, when I say amalgamation in the nature of merger that here. Okay, now please understand that now. So you know that we already discussed all the reserve and surplus is going to take over by the purchasing. They will record in their books of account. So what happened? Statutory reserve, basically these are the reserve which is mandatory has to maintain in the books of account. Like there are some in the provision in the income tax also. They have to maintain the books of account like export profit reserve and all that. Okay. So but in the nature of amalgamation, nature of merger, no need to additionally write that here. Okay. No need to write once again. You'll say why once again I have written that here? Because purchasing company is going to record the reserve and surplus also in their books of account. So is there a need to record the amalgamation, the statutory reserve once again? No. They've already recorded in second entry. But here, need to record statutory reserve. Why is need to record statutory reserve? Because amalgamation nature of purchase, purchasing company does not record this any reserve that day. You know that day. In the nature of amalgamation, nature of purchase, we don't record purchasing company reserve and surplus of vendor company. But there are certain reserve which is mandatory that they have to record, they have to maintain in the books of account. So they have to record. So separate entry, they have to pass for it. So reserve has credit balance. So what they will do that here? If the reserve has a credit balance, they will credit to statutory reserve account. Correct? But what should be debited? So they debit, AS 14 says that they have to debit to account and they call it amalgamation adjustment reserve account. So what they do that they will adjust to amalgamation adjustment reserve account. They will write it down. This is going to happen only in case of amalgamation in the nature of purchase, not in case of amalgamation nature of merger, because in case of amalgamation nature of merger, we have already recorded statutory reserve in our second entry because we want to record all the reserve that in case of a merger. Okay. So they say here entry is going to pass amalgamation adjustment reserve account debit to statutory reserve. Reserve is going to be credited, but what should be debited? So they say we have to debit to amalgamation adjustment reserve account. Now understand the logic here. Imagine a balance sheet. We have credited statutory reserve account. Agree? Yes, we have credited statutory reserve account. So that will come under reserve and surplus. Correct. But where is amalgamation adjustment reserve? They have a debit balance. Should I write it on asset side? No. They say this amalgamation adjustment reserve, it will also come in reserve and surplus as a negative figure because reserve and surplus has credit balance. We are debiting here. So we show the credit balance, we show the deduction. So they say here, now it is represented separately in reverse. Okay, now understand one. Let me talk about reverse later on. I will write it down the statutory reserve that here. Okay, all other reserve. And this amalgamation adjusted reserve we are going to show as a separately, not in inner column. We have to show them as separately that here now. Okay, we have to show them as separately here. Okay, now what happened that now? We pass the entry in the books of the purchasing company in the case of amalgamation nature of purchase that here now. Amalgamation adjustment reserve account debit to statutory reserve. These are the reserves that mandatory we have to maintain in the books of account to get certain benefit. For example, export profit reserve. Okay, investment allowance reserve. Okay. So they will tell you if there is statutory reserve, they will tell you in question that. Okay. Now what happened that here now? If but how long it should appear in my books of account? I am a purchasing company or a vendor company. So but it is the case of amalgamation in the nature of purchase. So I take asset and liability, not your reserve. But as it is statutory reserve, I have to record in my books of account. So I pass the entry amalgamation adjustment reserve account debit to statutory reserve account. Correct. So but how long should I maintain in my books of account this? So they say I am doing whatever needed. Suppose the law say that it should be maintained in the books of account for income tax act. Suppose say it should be maintained in the books of account for 5 years. So I have to maintain it for the 5 years. Remaining period, whatever is the mandatory on me. Suppose remaining period is 5 years that I have to maintain. So I will keep in my books of account. But once those period has been expired that day, I have to reverse the entry to cancel it that day. So we pass the entry initially amalgamation adjustment reserve account debit to statutory reserve account. Now what we have to do? We have to just reverse the entry statutory reserve account debit to amalgamation adjustment reserve. But they don't ask you for to reverse the entry in examination. I am telling you what happened in real life that. Okay. So this is how to represent that here. So we have to show them separately. I will write it down that here now. These items statutory reserve and deduction. Don't show any inner column. We have to show them as separately there. Okay. So this is the point that I want to discuss with you. We already discussed about the intercompany stock. Okay, and realized profit. So all the point that we have covered that here now. Trust me that here, this amalgamation and all that, it needs a practice that here. First is the concept and then needs a practice that here. So do a proper practice that here now. And this approach you have to follow that we have discussed all these points here. Okay, first we have discussed about the meaning that it, let's quickly revise it. What is the meaning amalgamation? When two companies come together to form a new company. Absorption, one existing company take over the business of another company. External reconciliation, one company formed to take over the business of existing company. Difference is okay. The accounting over it, two party, purchasing company, vendor company. Purchasing company, amalgamation nature of merger, amalgamation nature of purchase. And the vendor company. When we call the amalgamation nature of merger, if 5 conditions are satisfied. What are the 5 conditions? All asset and liabilities taken over and asset and liability taken over at book value, except exception we can do it for the uniform accounting policy. Now, if 90% equity shareholder will become the shareholder of the purchasing company, to the shareholder will give them share equity shares only, except fractional shares can be given cash, and the same business will continue by the purchasing company. When we talk about the PC that here now, so they might give you the lump sum payment. Okay, they might do the payment basis, how many shares we are giving, the benches are given, they will give. If nothing is mentioned, we have to calculate by net asset basis. Really, they ask for the intrinsic value. Okay, then accounting for amalgamation nature of purchase, we have to follow the purchase method. So first entry that PC due, asset, then second asset and liability taken over. If debit side gets short, goodwill account should be debited. If credit side gets short, capital reserve account should be credited. Then discharge of purchase consideration. Okay. Then other entry I discussed with you is the intercompany stock, intercompany mutual debt, and the stock reserve, liquidation expenses, and statutory reserve also. Okay. Then here is the accounting for amalgamation nature of merger. So amalgamation nature of merger, what we do that here? The only difference that we have to record a reserve and surplus also by the purchasing company. Okay. And what they do, the reserve and surplus, they will record all the reserve and surplus. Credit side get short, capital reserve, but debit side gets short, they don't write it goodwill, they will deduct from the capital reserve. If not, then from the revenue reserve, and if not available, then from the P&L account. Okay, like we have done in one of the question also that here. Okay, now what are the differences? Rarely they might ask you, but if they ask you that here, what is the difference between amalgamation nature of merger and amalgamation nature of purchase? Remember that here now. Then in these case, what you will do that here now? Here in these case that here, I'm going to say that now. Just write it down 5 points that here. Okay, that the all asset liability will be taken over. It should be taken at book value. Okay, same business, 90% equity shareholder, and it to equity share will keep that. These are the differences that. But one more is that 6-1. In case of amalgamation nature of merger, we follow pooling of interest method. In case of amalgamation nature of purchase, we follow the purchase method. Then I discussed with you accounting in the books of vendor company to close the books. So 12 step that is all asset transfer to realization, all liability transfer to realization, equity share capital reserve and surplus transfer to equity shareholder, preference share capital be transferred to preference shareholder account. Okay, and then here is the PC due. 6-1 is the asset not taken over, liability 7 not taken over, liquidation expense paid by the vendor company. Okay, then we receive the shares debenture, whatever that from the purchasing company, then we give it to the equity shareholder, preference shareholder, and at the end that here also the last one, if any balance left in the cash account, then we also give to the equity shareholder. Okay, a special transaction discussed with the intercompany dues, we deduct from the data and credit of bills payable, receivable, whatever the case. Statutory reserve we record in the case of amalgamation nature of purchase. No need to do that in the case of merger because already we recorded here. So we pass entry amalgamation adjustment reserve account debit to statutory reserve account. Okay, and that we show under reserve and surplus, but amalgamation adjustment reserve account will show the deduction. Intercompany stock, whatever is reserve, whatever the profit component is which is in stock that we purchase from the another company, I mean the mutual debt. Okay, not the mutual debt, that purchase, the amount that we purchased from the vendor company, the stock that we purchased from the vendor company or the purchasing company, and which is still in the stock that here. Okay, so we have to deduct the unrealized profit that we have in that. Okay, one more thing that I remember, just I know. Okay, this I told you that here. I will told you that here that I will tell you later on what is this here realization account. Now understand what is this. Okay, last point. Suppose there is a preference shareholder in a vendor company. It's a preference shareholder account. So there is a preference share capital of, let's say, that 10 lakh. So what we do that we transfer to preference shareholder account. So preference share capital account debit to preference shareholder. So we transfer this 10 lakh here. Okay, but suppose this 10 lakh we transfer there. But suppose we are it is decided to give to the preference shareholder, let's say 10 lakh. Sorry, 12 lakh. So I will write it down here 12 lakh. So I'm giving him 2 lakh more now. So the preference share capital amount is 10 lakh. But when I calculate PC, it is mentioned to give to the preference shareholder 12 lakh. So I'm giving him 12 lakh. What about the remaining 2 then here? So it's the excess amount I'm giving. The premium we are giving, the additional amount we are giving to them. So it will be adjusted in realization account. Okay, so remember this is the additional amount we are giving to preference shareholder. So the balance will come. So it will be adjusted in realization account. Okay, so we have discussed all the points here that, okay, so all the adjustment we have discussed here that here. Now, whatever that here, okay, generally these students are from the South Indian state that here, they're sending me messages that here. But if you like anything you want to tell me that here about the marathon or a series that here, please write it down in comment section that here. I will give reply there. Okay, and don't worry that here. 100% you are going to score 60 plus in advanced accounting. Let me tell you honestly that here. Just follow. You can see that it is a lengthy chapter that, but we have covered each and every concept we have covered that. Okay, just a 4-hour marathon that. The question is that. It needs a practice. The first concept in such a manner, strategy should be very strong. In a less amount of time, we should be able to do the revision. Now, this unique book that here Rapid in before the examination, if you have a paper today, the complete book you can revise in just 2 and 3 hours. That's it. This is what you should have a strategy to do the multiple revision in less amount of time. Okay, so all the best. I will come with the other chapter as well. The people were asking me for the consolidation. Don't worry, consolidation is very unique. In my notes that here, there are the steps for the consolidation. Okay, I will tell you later on. These are the steps that I will tell you the steps and all. Just you have to follow these steps that here. So I'm going to come easily. You will solve this consolidation chapter. Not at all. It is difficult that. Okay, so we'll conclude here. That is for today. Take care all of you. And it is my responsibility to simplify the accounts like never before. And we are going to simplify account like never before. That is for today. Take care all of you. Bye bye.